Apple, we're talking about millions of unit shortfall from Apple iPhones going into year-end off the back of those shutdowns.
What does that mean in terms of how much prices go up? Or does demand soften enough, and this is what some people would speculate, that perhaps it keeps things a little bit more even if people aren't buying the iPhone as much as they had previously?
So question for Dan Ives of Wedbush, and he's going to join us in the next hour. Permable, some people might say on Apple. I want to understand, is this profit and revenue deferred or profit and revenue lost for a company like Apple? If I want an iPhone and can't get one because I've got a delay, do I just sort of delay that until the next quarter at the start of 23, or do I get a different phone?
Well, that's the issue, is that how long do you delay? And then by the time you delay, they have a new edition out, then all of a sudden it's lost opportunity. It isn't necessarily just simply deferred and delayed. There's also the issue of demand in China, right? I mean, if the lockdowns continue and people have fewer disposable, they have lower disposable incomes in China, that also crimps their demand over there. I mean, Apple's in a tough spot with the reliance on China right now.
Have you seen the new operating system on the iPhone? You seen that? I've got a bigger clock on my phone that I'm not happy about. And if anyone out there knows how to make the digits, the numbers smaller on the clock, I'd love to know. Don't like it. Have you downloaded that?
I haven't downloaded it yet.
You did it automatically?
Yeah, well, mine's fine. My numbers are really good.
No, mine are like the big numbers. Anyway, it's the small things, Bremo, make a difference to my day.
I'm perfectly aware of this.
Futures down 0.8% from New York. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The global economy is clearly slowing, and that's the backdrop.
It's the global labor market that's really holding up still.
The key surprise of this year, right, has been the resilience of the labor market.
We have had a very steady pace in terms of overall spending, and the labor market is great.
There's definitely a chance of a replay of headline inflation volatility next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Christmas tree is up.
I know.
The lights are on. It's decorated. It's a beautiful thing.
I know. You're going to just troll Tom the whole morning, aren't you?
Tom's not with us because he's watching Cameroon-Serbia at home. Live from New York City this morning. Good morning. Good morning. You know I'm not joking.
Yeah.
For our audience worldwide on TV and radio, this is Bloomberg Surveillance with Lisa Abramowitz. I'm Jonathan Farrow. Kicking off a trading week and closing out the month of November potentially on a bit of a down note. Equity futures are down by 7 or 8/10% through much of this morning. Last couple of days of November still to come. Bramo, off the back of the events in China over the weekend.
Social unrest on the heels of some of the COVID-0 policies that are getting onerous, and that social images coming out that even fires have been lethal because firefighters couldn't get into the homes because of iron gates. At what point is zero COVID not necessarily preserving public health?
Waiting for the response from Xi Jinping and the government to see if they're going to placate the protesters, or ultimately, are they going to double down on COVID-0?
Can they placate the protesters, given all of the energy that they have put into preserving this policy based on the lack of immunization in the older population? How do they get themselves out of this?
No idea. We've got to talk about the price reaction as well in the face of this. You mentioned crude. I'm with you. We've gone from the low 90s to the low 70s in a couple of weeks. That's a $20 range on crude in the last couple of weeks.
And if the Xi Jinping administration does accelerate a removal of COVID-0, that should be positive for oil because that would increase the demand. So this basically is a bet that this will be increased turmoil, increased clamping down, and a prolonging of zero COVID. That essentially is what the decline in oil prices seems to suggest, although I cannot understand oil.
It's amazing how important this is for the outlook for 2023.
Yeah.
Not just where the Fed's going to go, but where China will be. And ultimately, you can't get a straight answer from anyone. You ask them a very direct question. What's your working assumption for China and COVID-0 in 2023? Is it COVID-0 or do they remove restrictions? Which one is it? And it's kind of like, I don't know after the weekend.
Either way, though, this is one consensus that you can get. Either way, it's going to be inflationary. Either way, if they do preserve COVID-0, that's going to prolong some of the supply chain disruptions. If they release COVID-0, that's going to be more demand for oil prices. Either way, you're going to have some sort of inflationary pressure coming in that's going to keep some of the central banks raising rates and keeping them at that level, which is the reason why I think that we are at an inflection point right now, where bad news is bad news, where yields can go down and stocks can go down. And that is a bit of what Dean Kernet was talking about and what we seem to be seeing this morning.
You thought I was joking about Cameroon-Serbia, 3-3.
I'm
game.
not joking. I watched it all weekend.
Awesome
I'll be
You've been
honest.
enjoying it.
It's amazing. It's really good.
You know, and how nice it is to see your face light up like
well,
that.
I mean,
excited
honestly,
about football.
these are incredible athletes. The athleticism is amazing. The games are riveting. The goals have been tremendous. I mean, it's not just Richarlison.
Is this disingenuous or not?
No, 100%. I watched it all weekend. It was actually genuinely exciting.
You're on board. I like that. Futures down about 0.75%.
I'm not being sarcastic.
I really am. I don't know.
No, I'm really not. I promise you.
Promise?
I can tell you about like the different kicks that I thought were amazing.
You're making me really happy
the
just
spin
doing this.
on the ball when those corner kicks that really made it in. Oof.
Okay, 367.75 on a 10-year, unchanged in the bond market. In the FX market, euro dollar 104.69. Bramo's going to run you through the ECB speak in just a moment. Euro dollar positive 0.7%. The Dutch central bank governor this morning, I think, making us all laugh, Lisa, turning around and saying, any talk of over-tightening at this point is a bit of a joke. Is it a bit of a joke?
Let's hear what Christine Lagarde has to say, because she's going to be talking about it. And if it is a bit of a joke, then that means that they have a lot more to go, and that means that they're going to be restrictive into a recession that could already be here. And I do just promise everybody, I actually was being completely honest and sincere about my enjoyment of the World Cup games over the weekend. Today, ECB's Christine Lagarde addressing European Parliament at 9 a.m. I don't think that she's going to be necessarily talking about the World Cup games, but she will be talking about inflation above 10% in the Eurozone and their commitment to getting getting that down, even if it means being restrictive. She's talked about how recession isn't enough potentially to reduce inflation in and of itself. We also hear from New York Fed President John Williams, who is going to be speaking at the Economic Club of New York. Very curious to how much he pushes back against the recent rally, not today, but over the past few weeks in U.S. stocks, in risk assets more broadly. Is that not what they want to see? Where is the cap where they are comfortable in terms with how tight financial conditions are? We're also getting Cyber Monday today. Thoughts?
Is that your leader for Cyber Monday? We're getting Cyber Monday thoughts.
It's
just so abrupt.
Honestly, well, I think that this.
Do you actually want my thoughts on Cyber Monday?
Well, you raised this good question. What's different about Cyber Monday than Black Friday,
what's different?
than Happy Tuesday, than Christmas Wednesday? I mean, honestly, every day is a shopping day online, and this is the reason why you haven't necessarily seen some of the crowds.
We're actually showing Amazon stock on Cyber Monday.
Yeah, well, I mean, honestly, it's down, and it's down so hard this year. I mean, it's down more than 40% this year. Shares lower today. Can we generate volume after people buy all the time? Why are you laughing?
Michael Purvis is with us from Toolback. And thoughts, Michael?
On Cyber Monday, no.
Let's get some thoughts on what's happened in China over the weekend.
Sure.
The unrest is serious. Demonstrations that we haven't witnessed on this scale for a long, long time in this country. I've asked the question through much of this morning. The outlook for 2023 hinges not just on what the Fed's going to do, but ultimately what the Chinese government does around COVID-0. What are the working assumptions for you?
Well, I think you said it earlier that, there's a very wide spectrum of non-answers you get on China, and it's because we just don't know. I mean, look, from June, we've been waiting for Xi to sort of accelerate the economy into the Congress, and we just had a few weeks ago. That didn't happen. Then after that, maybe we'll get some, aggressive shift more back towards the sort of the strong GDP trajectory that defined China for the last 20 years. We have not yet gotten that, and instead we're getting people's apartment houses locked down, literally locked down, and so I think that we're entering 2023 when there's just so many unanswerable questions. And China, which has been a pillar of global growth for the last 20 years, kind of underwritten a lot of global growth at various points in time, we just don't know where this is going there. And so that, I think, is going to just create increase sort of the, effectively risk premium across asset classes in many respects, some more than others there. But I think, Lisa, you were talking about this sort of call option on crude oil from Chinese growth that we should get, and maybe this is the catalyst there. But today that call options is declining in value. I think you have a good point, though. I think we may see this actually as sort of the catalyst to sort of get us a little bit more growth. But again, we're dealing with leadership here in China that is just very unclear about. It's not really articulated anything that the world markets have become sort of accustomed to for so long.
What's your baseline with China right now in COVID-0?
Well, look, I think we're going to get a little bit more of the same. I think we're going to see how these protests roll out. The news flow over the weekend was very disconcerting. One thing that if you look at that I'm a little bit concerned at for a U.S. market point of view is that if you look at things like implied volatilities on the Korean won, which takes a lot of China risk, right? Those have been trading right in line, just as the VIX has rolled over very nicely over the last 6 or 7 weeks since mid-October. There's a little bit of complacency within the EM, the Asia EM currency spectrum, if you will, and so I think we may see that kind of drive a bit of risk off over there, and perhaps a stronger dollar risk-off condition over here into year-end.
Have we priced in the potential for both supply chain disruptions to continue and potentially even higher energy prices enough to get to a place where people have priced that in, not necessarily the growth aspect, but yields can go lower on the long end, even as risk assets continue to sell off in the face of this uncertainty?
Yeah, no, I think that's, wouldn't be my base case here, but I think the supply chain issue is going to be very case specific. We're one of the broader structural trends that we're dealing with over the last couple of years that's going to, I think, really define 23 and 24 is this relocalization, right? But this is, you're still making a lot of iPhones in China, or trying to, right? And so I think we're still in the middle of this bridge of this transition here, which is going to create a lot of certainly very company-specific earnings stories here.
Well, Apple's one of those company-specific earnings stories, and for Apple, it's a little bit more complex. It's not just the expense involved in rejigging the supply chain. It's the blowback you might get from the consumer base in China. How do you think about that, Michael?
Well, it's a huge market for China, and I think that's, again, it goes back to one of these things where I don't have a crystal ball on what Xi is going to do and how the supply chains and how the China as producer, China as a customer is going to play out. All I know is that it's creating questions that are unanswerable, and if that is the case, that's going to put more stress on Apple's investor relations department. It's also going to increase the risk premium for owning Apple shares.
Is risk at the index level then of the S&P 500 or in single names, just relative to the composition of it?
For companies like Apple, and if we see other companies that are very levered to China as both from a manufacturing and from a demand side, you're going to start seeing that filter into the index level. I think the index story is much more muted because I think the complexion of the index is going to be very different. I mean, I think one of the things, we've seen a lot of transitions this year, obviously, with interest rates and inflation and valuations at the index level. But I think one of the other stories here is that the quality and quantity of big tech earnings growth over the last 8 years or so has been fantastic. That level of fantasticness is really, I think, starting to be questioned, not just on the micro level of, say, Facebook and Amazon with some of its input costs and so forth, but also just simply the fact that, how often have you heard Google complain about, advertising spend, right? Well, you're starting to see that. So you're starting to see you can't secularly grow forever, right? And so at some point you pick up good old-fashioned GDP sensitivity, and I think you're starting to see that. And that is going to, combined with the micro issues, start really, rolling into, I think, the index level, just given how big a weight they are.
Is the Christmas tree up?
Not yet, no. 2 weeks.
2 weeks' time?
Yes.
Why 2 weeks?
Well, it's because you want it to ripen on the 25th. Properly ripen.
You like to time it.
Yes. You don't want to.
You go natural.
Yes.
You like, okay.
Yeah.
There we go.
Yeah.
Good
you
to
do
know.
it old
Some people
school.
like the smell of it.
Yeah.
I'm just saying.
I like the smell of it too.
The smell of it's amazing.
I like walking past them when they're on sale on the street and
someone else
smelling
cleaning
the pine needles.
Yeah, I hear you.
Michael Purvis to talk back and great to catch up, sir, as always. Equity futures down by 0.7%. Coming up, Matt Dizok, the head of fixed income strategy for the Chief Investment Officer at Maryland Bank of America Private Bank. I laugh every time I read that title.
No.
Can we stop writing the title that way? Just shorten it up. From New York.
Bank of America.
I've told him before. It's ridiculous. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, protests against COVID restrictions are spreading. Citizens took to the streets and university campuses and vented their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai where some called President Xi Jinping to step down. That's a level of defiance unheard of since Xi took power a decade ago. The price of oil has fallen to its lowest level in almost a year. The protests in China clouded the outlook for energy demand. West Texas Intermediate fell below $74 a barrel following 3 weeks of losses. The unrest helped the dollar as a haven, which made raw materials less attractive. Retailers in the U.S. saw modest growth over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic, ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts lured shoppers seeking a break from inflation. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
The Fed needs to back off. It is absolutely clear, and has become clear over time, a lot of that inflation is coming from disruptions on the supply side. We have seen a lot of encouraging signs, even in the last consumer price index numbers, that things are turning over. We're seeing things work themselves out.
Claudia Sahm there, the Sahm Consulting founder and former Federal Reserve economist on the Federal Reserve. A lot of people on that page going into the Fed meeting a couple of weeks away. Live from New York is the price action as we look to close out the month of November over the next couple of days, with equities up on a month and down on a session. We're down about 0.7% on the S&P 500. Yields are basically unchanged on a 10-year, 367. Twos versus tens, though. I mean, it is absolutely amazing to see the curve as inverted as it is. And I don't think we should just gloss over it, Lisa. Twos, tens, almost negative 80 basis points this morning.
This used to be the key indicator to forecast recession in 12 to 18 months' time. It is deeply inverted, the most inverted going back to 1981. We heard from Dean Kernet. We heard from Brian Weinstein. They see it going beyond negative 100 basis points. Does this give any indication as to the duration or the depth of the recession, or just simply signaling we're due for a downturn?
You heard Claudia Sahm there. I do wonder whether we start to see a little bit more division on this Federal Reserve at the next meeting in the outlook. Just how wide are the projections? How wide are the bands going into next year?
Or is it Lael Brainerd and everybody else?
I don't know. I think for a lot of people on the committee, I think you can say the same thing that Brainerd said, but also say the thing that Chairman Powell said. I think you can say both. You can say both. He did.
The key issue will be when we get down to 3.5%, right? Inflation. If let's say we get down to a level, does this Federal Reserve have the commitment to keep going? A lot of people say no. that they're going to actually loosen up, that they're going to perhaps respond more to the employment and to the economic picture. If they do that, what does that mean for longer-term inflation? What does that mean in terms of the resolve of this Federal Reserve to have the inflation mandate that it has traditionally?
Chairman Powell speaking on Wednesday, then the Federal Reserve decision coming on December 14th. Been through the dates a couple of times, worth going over again. The end of 2022 is just around the corner. On the 2nd, you get payrolls. That's this Friday. On the 13th, you get CPI. On the 14th, you get a Fed decision. And this week, I understand, the Senate, lawmakers returning to Washington, D.C. Henrietta Trace, Director of Economic Policy at Vader Partners, joins us right now. Henrietta, for you, what's top of mind as Congress gets back to business?
I think just like with y'all, inflation is top of mind still. It's certainly going to be a huge focus as we consider roughly $2 trillion worth of legislation in the next 2 weeks. You've got an $840 billion Defense Authorization Act. You've got a $1.5 trillion government funding bill. And then you've got what could be about $300 billion worth of tax credits. And if the inflation argument is that this is really supply chain driven and COVID driven, senators are going to be more apt to consider the R&D tax credit, consider extending the EBITDA instead of the EBIT shift that will save corporations roughly $86 billion between just one of those, and then 150 or so between the two of them, and then tack on another batch of child tax credit expansion. And those are the main drivers of the Senate for the next 2 weeks, obviously heavily hinged on inflation and that argument for a recession as well.
Henrietta, this doesn't compute. On one hand, they're worried about inflation. On the other, they're on the brink of passing potentially a $300 billion stimulative bill that helps corporations and helps households across the country. How do these two things go together?
It's an interesting dynamic where the problem here is that the tax credits expired at the end of last year. So if you speak with investors, if you speak with a lot of lawmakers, and certainly if you speak with corporations, it's not technically stimulus on the business side. It's just an extension of the status quo. I wouldn't anticipate that the markets receive a $300 billion tax bill as a inflation or government funding driven package. Instead, it's mostly an extension of things that we've had for the last 7 years as part of the 2017 tax bill that they're just expanding instead of driving us into a situation where corporations will have to pay more taxes due to just the expiration of those credits. On the child tax credit side, I think that's the inflationary piece because that's seen as more of a domestic stimulus for individuals, which is obviously a much larger basket. And you'll hear that argument from Republicans that they don't think it should be extended right now. You'll get the same on the COVID side.
In the meantime, though, and you say the COVID side at the same time that the U.S. is trying to deal with what the potential fallout could be from unrest in China, I'm curious whether we can expect some sort of response, whether there is any response or preparation for either way, supply chains to remain constrained for longer or sudden increase in demand for some of the same goods and materials that the U.S. is looking for as well.
Absolutely. I think a really good leading indicator of how Congress is going to respond to that is going to come later on this week, as early as Thursday, when they start debating the National Defense Authorization Act. There are several amendments that are already pending to that bill that pertain to China, that are about national security threats, are about, for example, TikTok and whether or not it can be on federal government employee computers and devices. I think you're going to see a precursor to that entire argument before they get into it really in earnest in the weeks ahead, starting on Thursday when they do the NDAA. So I'd watch for that.
China front and center for all of us this morning, that's for sure. Henrietta, thank you for being with us. Henrietta Trace there at Vader Partners, all trying to work out the consequences of the protests, the demonstrations, Lisa, over the weekend.
This, to me, is the most important news over the weekend and potentially even of this year, heading into next year. COVID zero and how long can it continue? Because that has completely suppressed growth. And when you start looking at expectations over at Deutsche Bank for 2% growth globally next year, which is basically in line with recessionary global forecasts in the past, how much does this hinge on China remaining shut? How much does this hinge on them continuing with their COVID zero?
I thought what Goldman had to say about an exit from COVID zero was interesting. They said this: the central government may soon need to choose between more lockdowns and more COVID outbreaks. The current situation imposes further downside risk to our below consensus Q4 GDP forecast. Our 30% subjective probability of reopening before QT next year includes some chance of a forced and disorderly exit. That last piece is not something I've thought about much until after the weekend and the events we all saw play out there. A forced and disorderly exit of COVID zero. What does that look like?
I was thinking the same question. I can't pretend to be a China expert. I can say that as I was reading through different pieces of what that could potentially mean, they were talking about more protests, they were talking about more outbreaks, and if you can't control the outbreaks and people are just bursting out, then all of a sudden you have to sort of allow things to sort of unwind themselves. But if you get lockdowns, then more protests, then more outbreaks. This is disorderly, this is messy, but longer term it might get them out faster.
The vaccine efficacy is one problem
Yes.
in China relative to the vaccines that the rest of the world has been using, particularly the mRNA vaccines. So vaccine efficacy is one point, and the second point is coverage. It's amazing to me, that in the West we had this big conversation about vaccine mandates, and in some places we saw it in certain shapes and certain forms, and we've not seen that in China. An autocratic, authoritarian country hasn't gone forward with the same decisions that were made in the West over the last couple of years.
Take this even further. If the majority of an elderly population, the most vulnerable population, is not vaccinated, and if doctors were recommending against that vaccination initially in the cycle, why hasn't this administration of China come in and said, guys, you have to go get the inoculation, because we have to have something of protective measure ahead of opening up.
That brings up the potential for what Goldman's talking about.
Exactly.
A forced and disorderly exit from COVID zero. I stress potential, and you can assign your own probability to the potential of that happening. Coming up, Lara Rain, the chief US economist at FS Investments, looking forward to that. Futures down about 0.7 on the S&P. Yields unchanged on a US 10-year. From New York, this is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
2 hours away from the opening bell, equities down on the S&P 500, negative across the board here on the S&P and on the Nasdaq too. We're down about 0.75%. Elisa's going to pick up on Apple in just a moment. I'm going to run through the bond market for you. 2s, 10s and 30s. The spread between 2s and 10s pushing negative 80. Pushing negative 80. Unreal. 10-year yields this morning, basically unchanged at 367. A 2-year up almost a basis point to 446.29. In the FX market, euro dollar, some outperformance on the euro, the yen in G10, the dollar weaker, euro dollar 104.66, positive there by 0.7%. Lagarde coming later. Klaus Knott a little bit earlier. We've talked about his comments a few times from the ECB. It is not the time to talk about over-tightening. Any talk about over-tightening now is a joke. I wonder how much of a joke it is to you at home listening to that kind of commentary coming from an ECB official.
It's a bit flippant. I don't think that Christine Lagarde is going to take the same kind of approach, and it really does sort of highlight how some people see this as so obvious and other people perhaps see it a little bit more questionable. What do you make of that?
I think it's kind of bizarre. I don't think it's a joke to be talking about that. I think that's a debate we should have for an economy going into recession as to whether you should continue hiking interest rates. I understand the concern around inflation. It's justified. We should have that conversation too. But to dismiss it outright as if anyone who's talking about it is having a little bit of a laugh, it's a joke, I'm not on board with that, no.
Especially because it lacks humility when we've gotten it wrong again and again. It has been so hard to say.
Particularly the history of the ECB's got it wrong again and again and again.
So if people have gotten it wrong again and again and we're in an extraordinary time, it's hard to be overly dismissive about any potential outcome.
December 15th, the next decision from the ECB.
Well, it'll be interesting whether they also think it's a joke to think of over-tightening. I'm looking at a number of names, but Apple really is front and foremost, down almost 2% in pre-market trading as we see those protests disrupting some of the production at Foxconn. 1 in 6 iPhones, 1 in 5 of the new iPhones, iPhone 15, I believe, iPhone 14. Where are we at? iPhone 23.
We lost count.
Yeah, they're being produced in that factory run by Foxconn. It's also a demand story. Apple has been immune from some of the deepest pain in the tech sector this year. They're only down about 16% year to date. Does that start to change on the heels of what we're seeing over in China? That to me is a big question mark.
I couldn't agree more, and I think it's really complicated. It's incredibly complex. You heard Michael Purvis of Toolback and a little bit early this morning, about 20 minutes ago, talking about the risks associated with some of these companies moving supply chains. If you move your supply chain, if you shift your hub of production out of China and you're a company like Apple, what's the blowback look like on the demand side? Do you get that rise in nationalism against the iPhone, against Apple products because they've shifted their production base away from China? That's the risk that they'd be running, not just the increased cost of moving the supply chain and the production hub to I don't know where. There is also a risk of the demand blowback too.
This is the reason why a lot of people think that Apple hasn't moved as quickly. Another couple names that I'm watching Amazon shares up now after being down. Not necessarily that interesting given the whipsaw action that we've seen. But Shopify is interesting to me, and it's up more than 6%. It's that the platform for smaller businesses, and a lot of analysts are expecting there to be better than expected traction and better than expected shopping season. What's more interesting is those shares are down more than 73% year to date. So it's sort of like, have we baked in? Are we starting to see sort of bottom picking at this point with people going in and trying to find some of the sort of baby that's been thrown out with the bathwater?
You're telling us all about Cyber Monday a little bit earlier.
It's so exciting.
About that again?
Thoughts?
Did you buy anything?
I bought something on Black Friday.
What did you get on Black Friday?
I got, do you really want to know?
You look so ashamed of this.
I bought chargers for the phones. I bought hats for the kids.
What was the discount like?
It was like 30%.
Okay, nice.
What did you buy?
I did that with some Nike sneakers, running shoes.
All right.
30% off.
This is great.
You know the ones that make you run faster in marathons that I'm not going to run?
Seriously? Like
I was walking around the apartment
springs?
with them on Sunday.
Yeah, springing
and
along.
I could just feel myself just walking quicker. You know, it really made a difference for me straight away.
Wear them outside?
They're not going outside. They're just going to the gym.
You're the only
just
person
for
with
the gym.
indoor shoes. Oh,
What
my
do you mean? You
goodness.
don't have shoes just for the gym?
Just for indoor shoes?
Just for the gym?
No, I run
No.
outside.
Yeah, but if you were, let's say they were just for the gym, you'd wear them outside too.
No, I take my shoes off when I come in. I'm one of those people. Anyway,
Do you make other people take their shoes off?
No, I don't make other people take their
Good.
shoes off.
That's good to know.
I'm glad
Because I
that we're
don't
on the
like
same
those
page.
people.
You don't like
I've got
those?
a lot to say about those
Otherwise,
people.
we might have an issue.
I've got a good friend who turned up to a party over the last couple of weeks, walked in, got to the door, and he got the shoes off memo from the people at the party. And do you know what he did?
What?
No, turned back around and left the party.
Well, but
I would do the same thing.
Do you take your shoes off when you enter your apartment?
Sure, but I don't force other people to. And I wouldn't either. I've got a problem with those people.
But if you actually cared about it, and you had a close friend.
Well, they're not coming in the bedroom, are they? They're going in the living room.
I don't know. I think it's a sign of respect. I usually take my shoes off.
No,
when
I
come to
would
someone
for
else's.
them. I would offer.
Exactly.
But
Like,
I just wouldn't insist.
I think it's strange.
I think
that
it's
if somebody
strange to
doesn't-
insist that
I also
other
think
people
it's
take their
strange if
shoes off.
somebody doesn't take their shoes off if it's clear that
Do you
the
know
shoes are
how
on the
much
front.
feedback we're going to get on this? I think it's very odd to make guests take their shoes off.
I think
to
it's odd,
insist
though.
on it.
I agree, but I think it's odd for a guest to not see all the shoes at the front door and automatically.
This
take
is
their
why we
shoes off.
booked Laura Rank, the chief US economist at FS Investments, and she joins us now. Laura, great to catch up with you. It's a bizarre moment in this equity market because we seem to be pricing in a recovery to a recession we haven't had yet. Laura, can you run me through the potential for this downturn in America?
Yeah, markets are so forward-looking. I think they've really gotten over their skis in terms of seeing this reduction in the pace of Fed rate hikes and automatically assuming that there's light at the end of the tunnel and easing is really on the near-term horizon. To me, I look at what's happening in the bond market and the very clear expectation or the probability of recession that the bond market's pricing in, and the fact that forward earnings estimates on the equity side are higher for next year. When we have a recession, we usually get a drop in earnings of 10 to 20%. That's what we've had historically. So we're really seeing this divergence in recession expectations in the financial markets.
Laura, you also think that it is potentially not right that inflation is going to fall so significantly next year. That is completely not consensus. Can you explain?
Yeah. So, I do think that inflation has seen its peak in June of this year. So I do expect inflation to fall. But I am an outlier in that I don't think we're going to see inflation neatly fitting back into this 2% box anytime soon. I think we're going to need to differentiate between inflation coming down. We see oil off so significantly this morning. Some of these base effects are going to drag headline inflation lower. But there's a real difference between that and a world where inflation is reliably and persistently low. That is the backdrop against which we've had the Fed, keep interest rates at the zero lower bound, cut interest rates aggressively over 500 basis points if the economy slows. I think we're in a world now where we can't just assume that we're going to mean revert back to the world, what we've had for 20 years before the pandemic. Look at what's happening in China right now. We need to really resist the urge that our quantitative models are telling us to mean revert. That, to me, is the biggest concern going into 2023.
People would disagree, Laura. They would say, well, we still have an older population. We still have a lot of debt. We still have all of the ingredients of low inflation, and that in 5 years' time, this Federal Reserve will be trying to get inflation up, not get it down, and keep it at 2%. Why do you push back against that?
I think that what we're seeing right now, look at the 10-year Treasury. We have, if I had told you that we would have inflation of 7% in a 10-year Treasury that was still only 3 3/4, that is a world where demographic pressure is keeping the 10-year Treasury lower. We have quantitative tightening. We have the Fed selling Treasuries, or at least not buying them, and we have really, really high inflation, and the 10-year is still well below where inflation is. So I think it is a world where we're seeing demographic pressure applied to the long end. I just think that it's still a world where we're seeing, look at food prices. I think the expectation that supply chain disruptions are going to magically evaporate is being disproven this morning. This is still, we're seeing the echo chamber of COVID disruption. And I think really the genie's out of the bottle when it comes to inflation. Durable goods price deflation is a necessary portion of seeing U.S. inflation at 2%, and we're just not going to go back to that world in 2023.
Andrew Hollenhorst of Citi published just moments ago. He said the jobs numbers may serve to emphasise his hawkish focus on a tight labour market. He's talking about Chairman Powell. Laura, do you think that's important too?
I think this is critical. You know, wage growth of 4% is inherently inconsistent with inflation of 2%. We have had a lot of different recessions where we see very little change in output, but a massive decline in employment. This time around, you could get the other story. You could get companies really actually holding on to labor. That's part of the demographic story. And I think it's a reason why wage inflation is going to be much stickier on the decline. We've seen companies now have to continue to compete for workers, and I think that also is going to be a story for 2023. The wage numbers may become more important than CPI numbers, especially in the beginning of next year.
Interesting. Up like a rocket, down like a feather. I think it was Patrick Harker of the Philadelphia Fed a number of weeks ago. Laura, thank you. Laura Raim there of FS Investments. Those of you interested in the comments from Citi's Andrew Hollenhorst moments ago, our base case would have Powell guiding a well-expected slowdown to a 50 basis point hike, but the team goes on to say, remaining hawkishly, so by downplaying 1 month of softer inflation data, the jobs numbers may serve to emphasize his hawkish focus on a tight labor market.
All the rhetoric out of Fed officials has been the same, basically saying, yeah, step down makes sense, but that doesn't mean that we're going to have a lower terminal point. The market hasn't read it that way. If you look at what Fed funds futures are pricing in, it's below 5% now for next year in terms of the peak. It's come down quite a bit. How do they jawbone that back up if they are doing the step down? What we just heard there, though, from Laura Raim was really interesting. To your question, the wage numbers may be more important than CPI. How much does that start getting traction?
Payrolls on Friday. Would you like the feedback? It's quite normal to take your shoes off when you get to someone's home. This from Buy the Index on Twitter. We agree. It's just about whether you insist on other people doing the same thing.
Don't you think it's a little socially...
Shoes off, risk off, whatever that means. It depends on the shoes and the flooring. High heels on wooden floor is not so nice the next morning. So you have to assess people individually on whether they have to take the shoes off. Or you could just have a sign on the front door.
No, but don't you think it just makes sense? I mean, wouldn't it's just social etiquette that if you see them take their shoes off, you sort of like it's sort of a sign of that person.
I take mine off. Just if you turn up at mine, I just don't insist that you take.
Of course, it's sort of the question of messaging and etiquette.
It's that game you play.
But would you invite them again if they didn't?
Oh, depends on their behaviour, Bramo.
Ooh.
Futures down 7/10. They get a survey. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A sense of uncertainty is sweeping through Chinese markets as protests against the government and its COVID-0 strategy complicates its path to economic reopening. Goldman Sachs economists say they see a chance of a disorderly COVID-0 exit. Demonstrations across various cities and universities in China were fueled by a deadly high-rise apartment fire in Urumqi. Now, some blame virus restrictions for hampering those rescue efforts. Ukraine's President Volodymyr Zelensky is warning people to brace for more Russian missile attacks. In his nightly video address, Zelensky called it part of Moscow's effort to use cold winter weather as a weapon. Repairs are opening after a barrage of Russian missiles struck Ukrainian power plants last week. Federal Reserve Chair Jerome Powell expected this week to set the stage for slowing interest rate hikes. At the same time, he'll remind Americans that the fight against inflation will run into 2023. Powell will make a speech on Wednesday, one of the last from policymakers before the Fed's meeting December 13th and 14th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Save up to $600 when you pair your Peloton bike, Bike Plus, or Tread with accessories.
Step into your power, Peloton.
It's Peloton's best offer of the season. Visit onepeloton.com. Terms apply.
We all have a purpose.
purpose in life, a why. Maybe it's perfecting that special place that you want to keep in the family, or passing down the family business, or giving back to the places that inspire you. No matter your purpose, at PNC Private Bank, we will work with you every step of the way to help you achieve it. So let us focus on the how. Just tell us, what's your why?
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
If the frame is a shallow downturn or mild downturn, we would just say, open yourself up to the possibility more and more that no downturn is something that we have to fully price in and something that is not yet fully in the price.
The brilliant Luke Cower, UBS Asset Management Director of Investment Solutions, live from New York this Monday morning. Good morning. We are negative on the S&P 500, on the NASDAQ as well. We're down about 0.75% through much of this morning. The unrest in China triggering some of the concerns. Feels like sell risk and ask questions later. We'll ask some of those questions in just a moment. In the bond market, a 10-year 367.75, 2s10s. I mean, let's call it. It's basically negative 80 basis points on a yield curve this morning, Lisa. The 2-year versus the 10-year.
The most negative going back to 1981. At what point have we reached the end of this, right? And we were just hearing earlier this morning, potentially negative 125 basis points. What does that mean in terms of the depth of this recession?
Brian Weinstein at Morgan Stanley talking up that number. That's unreal, isn't it?
And talking about a 3.25% 10-year yield, that we could see another leg lower in yields from here.
Apple, one more thing to watch. The stock in the pre-market is down by about 1.76%. Our latest reporting here at Bloomberg suggesting the turmoil at Apple's key manufacturing hub in China is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. Dan Ives joins us now, Senior Equity Analyst at Wedbush Securities. Dan, I want to start with the Apple story and understand it from your perspective. Do you see that as profit, revenue lost, or just deferred, pushed out to the next quarter?
Look, I mean, it's been a gut punch. In the most important quarter, the most important period for Cook and Cupertino going into holidays. I believe it is deferred, and ultimately demand right now is outstripping supply by about 3 to 1. But I think really, look, the clock struck midnight. Finally, Apple is seeing, what's really the hurt in terms of production in China. We think it could be 6 to 8 million units.
So what does this mean in terms of Apple's share price, in terms of the earnings that they're going to see, even if it's deferred? What does that mean for the upcoming quarter?
Well, I think in the near term, Street's factoring in that you're clearly going to see misses on iPhone production as well as what we're going to see on deliveries. I think, Lisa, the issue is even going to Black Friday, I mean, we're seeing about 25%, potentially 30% shortages in Apple stores. If that continues to increase, depending on what happens on production, then this could be some darker days ahead in terms of the coming weeks going into holidays. But I think right now, Street's starting to factor that in. But let's just be clear. It's the Grinch that stole Christmas, really for Apple. And it's been a frustrating time for Cook and Cupertino.
This isn't a surprise, though, Dan. I mean, this is ultimately Apple's China problem, that their dependence on China, both from a demand side as well as a supply side, really ties their hands to policy that's highly unpredictable. How much is there a push internally to move away from production in China to increase, perhaps, demand and production elsewhere?
Yeah, and in terms of what we've seen over the last year and a half, Apple's been able to navigate basically better than any other company, within China. The problem is that now, at the most important time between the protests, zero COVID, and what we're seeing at Foxconn, it's really been a train wreck. I think for Apple now, they could talk about diversifying, but realistically, probably best case, they can move 5-7% production out of China by 2024. So I think their really hands are tied here, and that's sort of the frustrating situation because they are ultimately at the mercy of the zero COVID policy in China.
Well, Dan, let's build on that a little bit more. When asked the question whether it's profit or revenue lost or just delayed, deferred to another quarter, I think overwhelmingly the response from bulls like you is that it's deferred, just delayed until the next quarter. But Dan, underlying that assumption is that these difficulties in production go away over the next 3 months. Dan, I've spent most of this morning asking the question whether the working assumption is we get rid of COVID zero or whether we're stuck with it. And I can't get a definitive answer on that from anyone. And unsurprisingly, that's the case. So Dan, where does your confidence come from that the issues that these companies are experiencing this quarter are temporary in nature and won't just spill over into most of next year?
Look, it's a great question. I mean, look, our view is that ultimately, especially from a Foxconn perspective, they will be able to ramp production going into the next month or two, and then ultimately this will start to be more temporary. But to your point, it's an overhang. And it's really something that came to roost for Apple at the worst time possible. And really, ultimately right now, the Street's going to assume it's temporary, transitionary. But ultimately, if this continues in 2023, it would really sort of start to change the near-term thesis.
Well, that's the question you and I have explored a few times, Dan. How will I know if I'm wrong? You seem to have put a date on it there. If it spills into 2023, is that fair? Is that your line? If this continues for another month or so, I might have to change my mind about where I see this thesis going.
Yeah, if this continues for 4 to 6 weeks, look, then it starts to impact 2023. Then even iPhone 15, in terms of production, I think that's where it sort of cascades further. Right now, it's contained. You see that even reflected in the stock. But no doubt, I mean, this is starting to turn into a nightmare on Elm Street for Apple in terms of what we're seeing coming out of China.
It's contained, and yet we have heard about Apple potentially giving discounts to certain businesses on the margins, doing things that they have not done before because demand has so outstripped supply. And there's always been a willingness to spend $1,000 on a phone and people lining up around the block. Dan, is there a bigger problem for Apple that they're seeing both this issue on the supply side at the same time that demand is taking a hit in a way that perhaps they're starting to acknowledge on the edges?
Yeah, I mean, I think on the edges, you saw that in iPhone 14 Plus, which is really, I'll say, a strikeout in terms of as an overall, deliveries. But if I look at iPhone Pro, in terms of 14 Pro, it's 3 to 1 demand over supply. That continues to be robust. That's the frustrating thing for Apple. Even despite economic storm clouds, demand strong. They just can't produce it. And I think that's right now what they're trying to figure out. And I think this is a key I'll call it 7 to 10 days ahead, especially what we see coming out of Foxconn.
Dan, serious question. If you were hosting a holiday party, would you insist that people come over, take their shoes off? That's all we want to know this morning. Never.
I believe once you do that, it changes the whole dynamic. Once you say ask someone to take their shoes off.
Are you sending a message to someone, Dan?
Look, I mean, Saturday night, a good friend asked to take her shoes off. It was awkward for about 15 seconds, and then it continued. I think it changes the dynamic.
Dan Ives of Wedbush. Are they still mates after this? I love that.
I don't know. I mean, are they watching? Maybe they'll watch.
Open and honest he is. You ruined the night.
Yeah.
It's a good friend.
It's a good friend. You ruined the night. You ruined the dynamic.
I love this message I got on the Bloomberg moments ago. High heels on the ceiling of the neighbour below. You in a high-rise is unpleasant. As Paul Simon sings, one man's ceiling is another man's floor. People forget.
Okay, I'm speechless because I grew up in an apartment and I learned how to walk much more softly after a number of the neighbors came up and
you tiptoe.
slammed. You sort of tiptoe, yeah.
In heels?
No, I don't know. I take my shoes off when I come in the door, so I'm not wearing heels inside.
You think they're suggesting that I might be wearing heels at home?
I think that's
my indoor Nikes.
I think that exactly. It might be I'm not going to go there. I do think that there is an issue, though, with noise. Oh, God, please. That's a horrible image. But I do think that with the kids, it's very tricky with noise. I'm just going to go to that and try to not to go to that image whatsoever. It is obviously a hot-button issue. Do you think it actually changes the dynamic?
I think it does, yeah.
Because it basically... Okay, but then how much do you tolerate somebody else's quirks in your home and just think, okay, this is temporary, this is temporary.
Well, as you know me very well, I'm a highly tolerant person, and I'll be coming up, Matt Diesel.
I can't.
Of Maryland Bank, of American Private Bank. Right, but very tolerant. What are you talking about?
Tolerant about what? Yeah, but
if somebody want to kick back on a sofa, they can.
Okay, but if they do that too much, you just won't ever invite them back.
You don't want them to get too comfortable.
Exactly.
Make yourself at home, but not quite. Much. Sort of like 80% at home, maybe. From New York, this is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insight
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This year, a lot of the fear was about peak hawkishness and very high rates volatility.
As the economy is resilient, people just have to keep pushing back the timing of whatever recession or actual Fed pivot you get.
And if the Fed does too much, they're going to undo that relief and overdo it.
I think there is a slowdown coming through, and I think the Fed is acknowledging that.
We don't think we're really going to get a recession in the United States till 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back in a couple of days. Equity futures down 0.75%. The main event over the weekend and the concern spills into Monday. Lockdowns in China and aggressive pushback across the country to them.
How much does this end up leaving China in a different situation than it was in before? Basically, China having to capitulate to the groundswell of social protest against COVID-0, saying, okay, we have a problem here. We have to choose between more lockdowns and outbreaks, and we're going to go with more outbreaks.
Amazing to see how outspoken the United States is this morning. Again, another official this morning. It's difficult to contain a virus through zero COVID. That official went on to say, Elisa, that the United States says everyone has the right to protest, including the Chinese people.
How much is, okay, but that to me is a bit of a drumbeat on the whole, look, this is not necessarily a democracy, right? How much is this trying to message in something that is the one consensus in Washington, right? On the other hand, the U.S. needs China to open up for some of the supply chains to get worked through to help the inflation picture. It's also an issue with respect to global growth and how much that can really help bring the rest of the world out of recession as people are expecting.
This is a major issue for next year. For all the outlooks that have been published, haven't yet been published for 2023, how on earth do you have any kind of outlook without some kind of working assumption about whether China sticks with COVID-0 or ultimately moves away from it?
How quickly can that change, too? I mean,
sure.
That's what we heard from Brian Weinstein, who basically said, you know, our base assumption was that it lasted, and yet we might have to reconsider after the events of this weekend.
They can't answer the question. We said it a few weeks ago. If you're going to do an outlook for 2023, you should probably do two. One that includes COVID-0 and one that doesn't. Because no one can actually answer what the Communist Party is going to go with or not.
How about three? How about also whether it's going to be cold weather or we're going to get a cold winter, and whether COVID remains, the COVID-0 policies remain in China? I mean, how many outlooks do you need for such an uncertain backdrop with so many macro drivers that could really swing the difference one way or another?
So we're trying to get some clarity on the labour market December 2nd, on the inflation backdrop December 13th with CPI, on the Fed and the outlook. We get the summary of economic projections on December 14th, and that's kind of the final run-in, the final scheduled run-in for 2022.
Wednesday, to me, probably the most important data point that we did not mention were the
JOLTS.
JOLTS job openings. And we talked about that with Laura Rame, and she said that she's going to be looking for, in response to your question, she's going to be looking perhaps to a greater importance on wage data and on jobs data than even the CPI.
Andrew Hollenhorst City, totally on board. He said this morning the jobs number may serve to emphasise a hawkish focus on a tight labour market. Is that going to be the shift from this chairman? And is that how this chairman stays somewhat hawkish, even as we start to see downside surprises on CPI and PPI as well?
We've seen anecdotal layoffs, particularly in tech companies, but tech companies only account for about 2% of the overall labor force in the U.S. We are seeing companies hang on to their workforce because they've already been burned by not being able to bring people back. If that's the contour of this economy, is that a good thing or a bad thing? A good thing because people keep their jobs, a bad thing because perhaps the Fed can keep rates higher and raise them higher than people had expected.
A great story in the Journal over the weekend about how much these tech companies have hired in about this much time through the pandemic over a couple of years. We discussed Amazon doubling the workforce, Meta as well, doing the same thing. If anything, those companies have overhired through the pandemic and beyond.
That's why this is an idiosyncratic kind of sector that you can't take as a reflection of the broader sectors, because they did overhire in terms of some of the analyst expectations and analyst assessments. And so they're basically just going back to where they were before, or not even. And so it's hard to view that in terms of this is really a huge weakening in the labor market.
Futures down 0.8% on the S&P, on the Nasdaq 2 this morning. We are negative. Euro dollar positive by about 0.8%. Euro dollar 104.75. Yields unchanged at 367.56, but the spread between 2s and 10s, negative 80 basis points. Matt Diesel joins us now of Maryland Bank of America Private Bank. Matt, can we start with that yield curve? 2s, 10s at negative, let's call it negative 80 basis points. What are the limits of that trade, Matt? How much further can we push that?
Yeah, that's right. Negative 80 basis points. We haven't seen that in 40 plus years. Right. Last time we were this negative on 2s, 10s, I think Flock of Seagulls was top of the charts with Iran. So this trade probably doesn't have that much more to go, but we'll stay away from exactly predicting how inverted it's going to get. Lisa was making some very good points up front there, Jonathan, just like the tube in London. We got to mind the gap here. The yield curve, the labor market, and risk assets are all saying very different things at the moment.
Which one do you believe, Matt?
So I'm trying to find a narrative that explains all of it as usual. And I think the best way to think about it is the yield curve is definitely telling you a recession is coming. It's not here yet, but the check is certainly in the mail. 2s, 10s, that inverted. Fed funds 10s now inverted with further hikes coming. That tells you a recession probably a lock. But the labor market, Lisa, as you're pointing out, it's very strong. And even though there's anecdotal evidence of layoffs, you're not seeing a lot of jobless claims. The unemployment rate ticking up, which means that risk assets probably haven't bottomed yet. And then you look at credit markets, you'll see investment grade credit around 130, high yield around 450, way away from recessionary levels. So it tells you that the recession is probably delayed but not denied, and might be coming later. But the more difficult the macro picture gets, to your point earlier, Lisa, in some ways the easier the investment outlook becomes, in our opinion.
Because if it's a lock that there is going to be some sort of downturn, then you can go to the normal recessionary playbook where risk will do less well than perhaps safer assets. And we haven't been there. It's been sort of turned on its head. Is that basically what you're saying? That the end of financial repression will leave us with yield, but we're still on the path there that's going to be rocky and sort of motley, but we're getting closer.
Well, we are very thankful for, Chris Heisey, our chief investment officer, was asking us, what are we thankful for? And very sincerely, we are extremely thankful for the end of financial repression. The ability that savers, people saving for college or for retirement, or older people living on a fixed income, any American of any stripe at any part of their life cycle can now get savings above the inflation rate. We haven't seen that in 10 to 15 years. That is a great thing for people across the country. We're very thankful for that. In terms of the asset markets, because the future is always uncertain, obviously. Now it's particularly uncertain, as you mentioned, with the labor market, the disconnects with the yield curve, what's going on globally. Pull your horns in, right? We do think you should be close to fully invested. We are underweight cash at the moment. We are making sure to be overweight fixed income, but don't be too overweight growth or value. Don't be too overweight spread products versus treasury and Asian mortgage backs. All you have to do is be relatively close to your strategic targets across your assets, be close to fully invested, not too short duration, and a 60-40 portfolio over the medium to long term should do quite well from these valuation levels.
Matt, how do you convince people to be fully invested going into what you anticipate will be a recession?
Yes, it's very difficult. And one of the most difficult points is actually the fixed income market, where obviously the highest yields are about, the 1 year sector. 1 year T-bill is probably the highest point on the yield curve right now. So we see lots of clients, and I talk to lots of clients who are allocating money there. And they're saying, Matt, this is easy, right? I can get more yield and no interest rate risk by being on the short end of the curve. Why would I ever go out longer? And we try to explain, right, without being too nerdy, right? Like the conservation of mass, that mass is never created or destroyed. It's the same thing with risk. Risk is never created or destroyed. It just takes different forms. So for clients who have abandoned longer-term fixed income to move into cash, yes, they're eliminating interest rate risk, but they're way increasing reinvestment risk. And that 1 year rate, which looks wonderful right now, if you're investing for the long term, in a year, 2, 3 times, it might drop, and you're really creating a lot of reinvestment risk if you move all to the short end. So we're trying to convince clients that by abandoning longer-term fixed income, staying short, yes, they're reducing interest rate risk, but they're taking a lot of reinvestment risk. It makes a lot more sense in your fixed income portfolio to be neutral with an eye to going longer. When the curve gets this inverted, that's generally a sign you should be longer. That teaser rate, that attractive short-term rate, can try to trick you to do the wrong thing, in our opinion.
Matt Dezog, thank you, sir, for your opinion of Maryland Bank of America Private Bank on the yield curve. That's going to be a hard sell, a tough pitch for a lot of people, Bramo.
It's going to be a recession, but in a recession, you're going to want the yield, even if it's lower than what you're getting in the short end. And in a recession, the reason why this, I'm wrapping my head around this.
Trying to work out in real time or just doubting what you just heard?
I think I'm working out in real time what it means, because in a year time, the reinvestment, ostensibly if you're in recession and stocks are pricing in recession, there could be other entry points, perhaps just not in fixed income, right? So I'm just thinking through this out loud, but I'm going to move on. I do think it is a hard sell, but you are seeing people do it. You are seeing people go into longer-term yields.
Everybody listening wants you to move on. We want more.
What, to say basically I'm not?
You disagree?
I just think that in a year's time, ostensibly, we could be pricing in the end of recession in stocks. If there's a potentially 19% downside, as Deutsche Bank said in their review, from the S&P from here, then wouldn't that be a better entry point for some of that cash that was coming off? What do you think?
I think you've made good arguments.
Oh, you punted. What do you think about shoes?
I can tell you a lot about shoes.
Evidently, but you're going to punt on this, huh?
I can tell you a lot about shoes too. Senior equity research analyst at Cowen has got a lot of things to say about retail, and Lisa's very excited for Cyber Monday.
Oh, yeah.
It's a big event, big
Thoughts?
shopping event, I'm told.
Yeah, any other thoughts?
Well, that's your first question for Oliver at the moment.
Thoughts?
No, I don't spoil it. This is the tease, Lisa.
Thanks.
I want people to stick around from New York.
Now.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, in China, protests against COVID restrictions are spreading. Citizens took to the streets and university campuses and vented their frustrations on local officials and the Communist Party. Huge crowds gathered in Shanghai, where some called on President Xi Jinping to step down. That's a level of defiance unheard of since Xi took power a decade ago. The price of oil has fallen to its lowest level in almost a year. The protests in China clouded the outlook for energy demand. West Texas Intermediate, it fell below $74 a barrel following 3 weeks of losses. The unrest helped the dollar as a haven, which made raw materials less attractive. Retailers in the U.S. saw modest growth over the Black Friday weekend. According to data compiled by Sensormatic Solutions, in-store traffic, it ticked up 2.9% at brick-and-mortar retailers over 2021. Deep discounts lured shoppers seeking a break from inflation. Turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after violent protests against COVID restrictions. And shares of Credit Suisse hit another record low today, and they're on track for their longest losing streak since 2011. The Swiss bank has fallen for 10 straight days, losing as much as 27%. Last week, Credit Suisse warned about massive outflows in the core wealth management business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
There is a slowdown coming through, and I think the Fed is acknowledging that, and that's part of the reason why it's talking about moderating the pace of hikes relatively soon.
Big week up coming up with the Federal Reserve Chairman Jay Powell speaking on Wednesday, and payrolls coming up on Friday. Then the Federal Reserve decision coming up on December 14th, just after CPI on December 13th. Equity futures right now down 0.8% on the S&P 500, going into the opening bell, looking to climb through November for another month of gains on the S&P to add to the gains we saw in October and take a chunk out of the losses we've seen through 22 so far, Bramo, trying to get back up there.
This is exactly Mike Wilson's crystal ball. He said that we would get a rally, potentially to 4,100, and here we are.
And then get hammered in Q1.
Exactly.
Off the back of the earnings story for Q4.
That's the consensus. Even Deutsche Bank says that we're going to potentially rally more, and then we're going to come off. This is the consensus. It's sort of a technical, yay, end of year, let's buy a Christmas tree at Thanksgiving.
If Binky Charter gets his 47.50...
Yes, what then?
I owe him a monster apology.
You know what?
For laughing at his
All you have to do is just wear a fat tie that day.
A fat tie? Is
yeah,
that
yeah.
Why a fat tie? Is that
because it would just be like the real sort of acknowledgement.
What do you define as fat?
Not bad.
Not bad.
Yeah, we'll discuss it. I think it's great, but it's your style. It would be sort of the biggest capitulation would be to wear, a big tie, or else a white
says,
suit.
"I'm sorry, Binky."
I'm sorry,
what
Binky,
does
for every
wear
doubting.
If we don't get 47.50?
He has to wear a skinny tie for the rest of the year.
Well, that's probably an improvement, isn't it? If everyone goes slim, no.
Binky, we're sorry.
Oliver Chen joins us now, Senior Equity Research Analyst at Cowen. Oliver's got things to say on that. He actually does. Oliver, I want to understand this. Lisa's been joking about Black Friday, Cyber Monday. Help me understand whether Black Friday started on Friday or back in May when Target reported earnings.
Well, Black Friday has been going longer, particularly with Amazon and Amazon Prime. However, what's really happening, John, is shoppers are coming back to pre-pandemic habits, and they are shopping later. So we will see later shopping, people really going to stores close to need. That's happening as well. Keep that in mind. Overall, we are enthusiastic about what we saw in stores on Friday. We're positive on Cyber Monday. We're looking for holiday sales overall plus 5 to 7%. And traffic was quite attractive. Black Friday has really changed. Not as many doorbusters, a little more relaxed and more convenient, but it's still very important, John.
Yeah, well, nobody wants to wake up at 4 a.m. to go to the stores. I mean, that's probably part of the reason why everyone's kind of giving a sigh of relief that doorbusters are kind of fading into the past. You talked about foot traffic being good. Yes, however, the discounts also were very good. How much are you going to see this bleed into massive margin compression because people are looking for those discounts?
Yeah, Lisa, that's 100% correct. Gross margins, as we model them, down anywhere from 50 to 100 basis points or more in fourth quarter. So in the guidance that a lot of retailers have out there, there's merchandise margin pressure, meaning there's a lot of promotions in the marketplace, 20 to 40% or more. And the big problem is inventory levels are too high, 10 points or more too high. So there's billions of excess inventory as well. And retailers are working through that. That should be very good for the consumer, 30% plus. But as John and I were talking, not all inventory is on sale. There's pockets of great strength, and that really feeds into the consumer being bifurcated. Luxury, premium, that's been a stronger market generally. But inflation is a huge deal for the middle and low-income consumer.
Oliver, talk to me about luxury and how it's holding up. Because one transformation we've seen over the last, I would say, 5 years or so, is how much access to very, very high-end brands has increased off the back of buy now, pay later. Can you tell us how that trend may have reversed over the last 12 months or so, given what's happened with access to credit and what might be happening with these luxury brands down the road?
Yeah, we're really watching that because the savings rate has declined to 3.1 versus a 7 to 8% average, and the dollars on the sidelines, there's still over $500 billion on the sidelines, but it's declining. So that's something we're watching. What we see in luxury is the access luxury points, such as the belts and footwear. Those have been more over inventoried. But as we think about super premium brands, Chanel, Hermes, Brunello Cucinelli, those trends have been very strong. The U.S. has been very strong. Also, U.S. tourists going to Europe. European numbers have been strong, too, in luxury goods. Overall, it's been a resilient market that's been able to achieve pricing. And don't forget, going out and travel, fashion, dresses, all these events that we're seeing, it's important to look good, feel good, have the right accessory, footwear, and suiting. You know, we're talking about ties. Going back to work is a new wardrobe refresh. It's not about lounge anymore. It's really about this dress up and suiting it over swimwear in terms of what we're thinking, what's happening now.
Oliver, can we just finish there on the suit? Where should we go and get a suit from now? Because whenever I look for suits, let's take Hugo Boss, great example. If you go down to Hugo Boss on Broadway, the suits aren't even in the front window anymore. They push them to the back. They've hardly got any in stock. Who's making suits now? Who's sticking with it?
Well, this is Brooks Brothers. So back to the future, back to the 90s, and that's a heritage brand. I like what they're doing. And then Nordstrom has a very competitive men's offering as well. And you call out Hugo Boss. They have a rich history of executing in men's too. But we'll see. It's an interesting question, John, because men's clothing, men's suiting, the versatility, looking for comfort. It's really about mix and match. It's Rhone pants and athleisure plus a tailored top. That's happening too. But there's also a return to formality. So lots of different trends happening simultaneously. I have been personally shopping Brooks a lot lately.
I know a ton of men waiting for Lulu to make a suit.
I know.
Just
actually,
the Lululemon suit.
Well, there's Lulu suits. I have a Lulu blazer, a Rhone blazer, and comfort matters too. So we're really seeing technology hit clothing and fabric. That's a trend as well.
It's the Midtown uniform, isn't it? The Patagonia vest and the Lululemon pants.
Stealth lounge, wrapped in sort of dressing up.
Is that
that's the Lululemon. That's, well, I mean, because people want to be comfortable, but they want to look like they're not, right? They want to look like they're dressing up and they're going to the office, but they kind of still like the lounge. I'm just trying to
be comfortable, but look like they're not.
Well, look like they're dressing up. I'm thinking about this because I was speaking with one of the heads of a pretty major clothing company who was talking about buying and that shift where they were moving from loungewear to office wear. And there are no statistics, there are no charts. The trends all just shifted. Suddenly people wanted to go back to the office and go out, but how do you prove it, right? And so then when do we prove that people are getting sick of dressing up? You know, I mean, how do you prove these trends?
Oliver Chen's not sick of it.
No,
Oliver Chen,
no,
accountant.
he's-
Oliver, thank you. It's always good to catch up with you, sir, around shopping season, going into Christmas.
Do you have some
and the
tips
holidays.
now on
No,
shoes?
just suits. I'm struggling.
Really?
Yeah.
I thought you have one brand you always go to.
No, I have a few brands, but I'm struggling. The brands I like don't have things in stock. It's been very difficult to get the things that I like. It's been difficult.
But that is the key, that luxury brands, since yours are luxury brands tend to have smaller inventories and bigger demand because people are still clamoring for those products. That's the truth.
What do you think of buy now, pay later and all of that stuff?
I think that we're starting to see some credit deterioration on the consumer
No, I think
side.
all of a sudden stuff like Gucci became very accessible to a lot of people. It became a monthly payment. Monthly payment instead of a lump sum.
Which also bid up prices. So do you start to see a lot of the demand pulled out of the
Well,
market?
at this point, it's going to be fascinating to see how these luxury brands deal with it.
I think that people who have money, though, if you look at the savings rate, it's still pretty massive.
No, they have money. I'm just saying that not everyone who had money shopped at those stores over the last 5 years.
It'll be more selective, perhaps.
It's going to be interesting to see what happens. From New York, good morning. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
60 minutes away from the opening bell, equity futures down 0.75%. Big week ahead, payrolls on Friday. The Federal Reserve Chair Jay Powell speaking on Wednesday. Then into December, you've got CPI on December 13th and the Federal Reserve decision on December 14th. So they're the markers on the Canada going into year end. Right now, equities are lower by 0.75%. Yields unchanged on a 10-year, 367.19 in the FX market. Euro showing a little bit of strength. Euro dollar 104.49. Trying to work out what's going on with crude. 74 handle on WTI. It was lower than that a little bit earlier. We're down by 2.8%. The move we've seen on WTI, though, from the low 90s to the low 70s, Lisa, in just a couple of weeks.
Especially because what we saw over the weekend, does that give people conviction that China can stay with COVID zero? I mean,
no idea.
Is that basically what lower oil prices implies, or just that more volatility could potentially suppress growth in the near term?
That screen this morning just screams sell risk and ask questions later.
Exactly.
The events of the weekend, I've got no idea what the consequences will be.
Although sell risk, then what explains the dollar? Why is the dollar so much weaker? Because normally when it's a risk-off kind of feel, the dollar strengthens. The most notable trade to me is that the dollar has steadily weakened to the weakest versus its peers going back to August, if you look at DXY.
Since it peaked back in late September, the turnaround we've seen on things like sterling, cable from 103.50 through 120, euro dollar from, I think, 0.95 to 104 right now.
Have you seen the yen? The yen has absolutely massively rallied versus the dollar, which is completely counterintuitive because they haven't changed their yield curve control policies.
138, they're just hoping and praying something around them changes.
And they
don't have to change.
But again, this makes me wonder whether this is all just, I don't know, positioning squeeze and kind of rearranging heading into year end rather than something that we can really create a narrative
If it's something you can't explain as positioning, right?
Correct.
That's
Absolutely.
always the way.
I try.
Ray Ferris joins us now, Chief Economist at Credit Suisse. I'm pleased to say joins us in the studio here in New York. Ray, fantastic to catch up with you, sir.
Great to have me. Thanks.
Let's start with the chairman on Wednesday. What are you looking for from Chairman Powell this Wednesday?
He's going to find a way to slow to 50 basis points and yet still be hawkish.
How does he do that?
I think the way he does it is similar in nature to how he did it at the last meeting. He stresses that they've still got a lot of work to do. He quite possibly might suggest that, well, they don't stop at 5. They may have to go to 5.25, and that they're going to stay there for longer. They'll continue to point to the labor market being strong to justify all that. But I think the messaging out of the Fed is that they're not wild about this rally in treasuries, rally in markets, the easing in financial conditions that's come with that. And I think they still just absolutely hate markets pricing them to cut into the second half of next year.
They've already pushed back against this. This is the most amazing part. They've already said, stop it. We don't want you guys to rally because we're not going to cut. They said this again and again, and the market still has moved against them. What else can Jay Powell say other than, we're not going to stop at 3.5% inflation. We're going to keep going. How do they signal we are going to have some sort of call? We're going to have basically a cap on how far you guys can go.
I think he'll, again, do what he did in September. He's going to point to a higher terminal rate as a real possibility for the Fed. Keep open the idea that 5.25 could be there. And there's only so much, negative term premium that I think markets can take. So we're not going to disinvert the curve. That's just not going to happen. I don't think it happens unless something really fantastic happens in Europe that creates an outlook for Europe to come out of recession. But the more you drag the front end higher, the more that the back end of the curve is going to have to be dragged, it's going to have to creep up as well.
A lot of this has to do with the actual economy and the actual data, and people say keep watching the data because the Fed doesn't know any better than anybody else. And we heard from Lara Rame earlier this morning of FS Investments that it all is about the labor market and that ultimately the wage data might be more important than the CPI, given that there is this stickiness, there is this strength in the labor market that puts a lot of pressure on the Fed.
The labor market justifies what the Fed's doing. The CPI is the objective. If the Fed can get inflation down to close to its targets with a labor market that remains pretty healthy, really remember that in 2019, the labor market was pretty strong and inflation was where the Fed wanted it. If anything, the inflation was a little bit low. So one of the things that we've been pointing out is, the idea that inflation, or I should say that unemployment has to go back to 5.5%. Or that average hourly earnings growth has to fall to 3% to be consistent with the Fed's objectives. History just doesn't support that. So if the Fed can achieve disinflation with a labor market that's only modestly weaker than it is now, it'll take it. inflation is what the Fed's going to focus on.
How much has changed between the pre-pandemic labor market and the labor market we have today? How much has changed when it comes to things like where the neutral rate may or may not be this time versus compared to them? How much do you think has changed?
I think the key thing that's changed is we've taken, in a labor market that's already lost a lot of potential workers because of immigration changes that have reduced immigration since 2016, we've taken a lot of workers out of the labor force. So labor force participation rate has fallen, particularly among older workers, 55 and above. And although it's creeping back up, it's going to take a lot of time for it to really recover. And so from the Fed's perspective, what that means is that for all intents and purposes, you've had a permanent shift lower in labor supply. And that's part of its problem. But look at the inflation data. Goods prices are beginning to do what they're supposed to do, with a strong dollar, falling import prices, softening consumer demand. Although discounts in this, Thanksgiving Day and Black Friday were not epic, there were definitely discounts. One of the big fears we had that retailers would say, we want to protect margins, that didn't really materialize.
Sure.
In the housing market, housing is one of the strongest components of contribution to CPI right now. It's also one of the things that's most forecastable. And rentals are now beginning to come off. You look at the high-frequency data, and in September and October, rentals actually fell. House prices are coming down. So it really comes down now to just non-housing services, and that's still running a bit hot. The labor market looks like it's beginning to soften. We think services growth, non-housing services will continue to grow, but will again soften into 2023, and that'll start to come down. It's going to take until the end of next year. It's not going to be, first quarter or second quarter, we don't think. But the Fed has a reasonable chance still of getting a disinflation that doesn't require 5.5% unemployment.
So the Fed's not going to keep on hiking until they see 2%. They're going to keep on hiking until they're convinced they're on the trajectory to go back towards 2%. What does that look like, do you think? How do you know? What convinces you?
That's the million-dollar question that the Fed has right now. So the slowing is about the fact that the Fed knows it is now restrictive. It knows that because it can see it in housing. It can see it in other areas, some, major company layoffs. But it doesn't know how restrictive it has to be because it can't trust its models. The message out of senior Fed officials is the models didn't forecast inflation on the upside. Why should we trust them on the downside? So we have to look at the hard data. We have to be backward looking. If you're going to be backward looking, you run a much higher risk of overdoing it. And how do you manage that? Well, you gradually slow down the pace of hikes while still remaining hawkish and saying, we're going to keep going until we've got mission accomplished. So we think they do 50 in December. They probably do another 2 25s in the first quarter of next year. We don't rule out the possibility they go to 5.25.
How different is your economic outlook depending on whether China exits COVID-0 or not?
I think the main thing in my mind, the risk, and that's a key question, because the risk that emerges from China exiting COVID-0, and particularly a sooner than expected risk, is all about energy. I think one of the biggest vulnerabilities from an inflation perspective for 2023 is energy. U.S. inventories have gone from 1.2 trillion barrels of oil down to 800 million, roughly speaking, and are continuing to fall. We're about to get a regime in Europe that is going to take some Russian oil off the market. And remember that Russia's actually been supplying the market pretty much at the rates it was supplying the market before the invasion. And if the oil prices have fallen, but they're still above 2019, pre-pandemic levels, if China comes back in and adds back demand of, 1 million to 1.5 million barrels per day, we could get oil prices bouncing again. And that would be particularly unhelpful.
That's the problem, isn't it? Is it bullish or is it bearish if China reopens?
You've been asking that question. We've been asking that question. Nobody has a straight answer because on certain aspects it'll be bullish with respect to global growth, and then it's really bearish when it comes to economies that are going to struggle in the face of higher energy prices.
Go on, Ray.
It doesn't really do much for the U.S. economy. It will contribute a little bit, probably to some corporate earnings. It really focuses much more from an investment perspective on China itself and Asian assets. Asia has a much bigger gearing to Chinese reopening and a greater degree of activity in China, especially Chinese travel. That's going to benefit Thailand. It's going to benefit the Philippines. It's going to benefit Southeast Asia much more than the United States.
And some of the luxury names in Europe, that's for sure.
Balenciaga
in a major way.
Hermes, yeah, exactly.
The rally we've seen in European equities off the lows of late September have been phenomenal. Ray, this was awesome. Thanks for being with us, sir, as always. Ray Ferris there of Credit Suisse. Coming up at the Open, we'll be catching up with Matt Miskin of John Hancock Investment Management, Greg Staples of DWS Group, and Victoria Fernandez of Crossmark Global Investments. Looking forward to that. Bramo, as we kind of count down towards the end of the year now, just a few events to go, a handful of events before the end of 22.
Yeah, I mean, it kind of feels like we just have 2 more weeks and then we're done. And it feels like people are kind of jittery heading into year end because there are a lot of big events and there isn't a lot of conviction. Do you feel conviction?
The year ends on December 14th.
Yeah, I would say that that's right.
You skipped the ECB meeting?
Yeah, pretty much. I mean,
tell us how you really feel about the European Central Bank.
ECB, what are they going to say? They're going to say we're going to keep tightening rates. I don't think that they're going to have Klaus Knott's kind of view. I think that that's a little bit too flippant for the ECB. I'm interested to hear what they have to say. What do you think they're going to say? Do you think it's an important meeting?
I think it's always an important meeting. They're going to hike into recession. It's kind of brutal.
It's brutal. Do you think that they're going to say that it is recession?
That would be interesting, see if the base case shifts.
Well, in the meeting minutes, the Fed was basically saying that.
They're going to wait until they actually just see one and say, yeah, now we're surprised the base case has shifted. It's kind of ridiculous. When's Tom's back?
Tom's back Wednesday.
Wednesday. Good for him. All right. Futures down 7/10, the opening bell, 50 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A sense of uncertainty sweeping through Chinese markets as protests against the government and its COVID-0 strategy complicates its path to economic reopening. Goldman Sachs economists say they see a chance of a disorderly COVID-0 exit. Demonstrations across various cities and universities in China were fueled by a deadly high-rise apartment fire in Urumqi. Now, some blame virus restrictions for hampering those rescue efforts. Ukraine's President Volodymyr Zelensky is warning people to brace for more Russian missile attacks. In his nightly video address, Zelensky called in part of Moscow's effort to use cold winter weather as a weapon. Repairs are ongoing after a barrage of Russian missiles struck Ukrainian power plants last week. In Houston, schools are closed today, and residents have been warned not to drink tap water without boiling it first. That's because power outages have shut water treatment plants. Office towers have told tenants the problem will not affect fire suppression and air conditioning systems. After cutting thousands of jobs, Twitter now hiring. That's according to slides from a company talk tweeted by owner Elon Musk. The first slide had the words, "We're recruiting," with no further details. The slides also said that new user signups are at an all-time high, averaging over 2 million a day the second week of November. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. it's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Even in the US, a slowing economy across Europe, and it's, you know, how do you go running out on all these cheap prices to buy things when you're worried about energy costs, worried about mortgage payments, and so on. So, you know, the global economy is clearly slowing, and that's the backdrop.
Kit Jukes, Societe Generale Chief FX Strategist, on Cyber Monday, when a lot of people are going out and buying things, but on discount. We've been talking about that throughout the morning, underpinning a lot of the angst this morning, because we are seeing equities lower. We are seeing bonds higher, yields lower, the traditional risk-off kind of feel in markets other than the dollar, but we'll get into that later. How much is this really being fueled by what we're seeing over in China with ongoing and spiraling protests that are causing some to draw analogies to 1989? Joining us now is Tom McKenzie of Bloomberg, who spent about a decade in China. How different is the nature of these protests that you're experiencing now versus what we've seen over the past few decades?
Yeah, Lisa, during my time in China, I witnessed protests. They were normally almost always localized, specific issues, and almost always targeting local governments. Very rarely did you hear criticism of the central government. Very rarely did you hear criticism of the party secretary, the president, in this case, Xi Jinping. This time, it is different. And I can think of no other event other than 1989 that is comparable. And it's easy to reach for that as a heuristic, but I don't think it's hyperbolic in this instance, because you have multiple protests in multiple cities happening at the same time around a similar set of shared issues and concerns. And that we have not seen since 1989. And therefore, you are going to have the officials sitting in Beijing deeply concerned, and the response from them is, of course, what we're all watching next.
We're hearing reports of Chinese television cutting away from images at the Qatar World Cup of people enjoying without masks. There is a clampdown on information. How surprising is it that these images are getting out?
this is the dual world that the people of China are living in now. They have spent 3 years faced with these kind of restrictions. And the restrictions that we've seen in the last few months are the tightest they've been within that period. There's a huge fan base when it comes to soccer or football in China. So they're going to be watching it, and CCTV, the state network, has the rights to it. But you're absolutely right. They've been trying to make sure that they can't see the thousands of fans in those stadiums without masks, because of course that is our reality, and that is the reality of most people outside of China's borders. That is proving another friction point for people stuck at home as they watch these scenes. This is a Chinese leadership that has squandered its own success initially in the early 2020s, of course, when it clamped down on what happened with COVID, when it spread out of Wuhan. It clamped down very effectively. The death rate in China is very low. The infection rate is very low. It's nowhere near the death rate that we got here in the UK, in the US. But they've squandered that time to build out their healthcare system, to ensure those vaccination rates are higher for the elderly, and to put in place mRNA vaccines that they still do not have access to in China.
So which raises a question, Tom, and we've been asking this all morning. Why haven't they taken a stricter line with vaccinating older individuals? Why haven't they come up with vaccine distribution methodologies that could potentially create some sort of collective immunity?
So on the top line, it looks quite good. About 90% of China's population have been double vaccinated with either Sinovac or Sinopharm. There's questions, of course, about the efficacy of those vaccines, particularly compared to mRNA. But when you lift the lid on those numbers, you realize that actually above the age of 80, and of course the vulnerability is there with those age groups, the vaccination rate is closer to about 70% compared to, say, 90% in Japan or Germany, certainly lower as well than the vaccination rates of that age group in the United States. Why haven't they got more vaccines in arms remains a question. They obviously have the manpower to be able to do that. It's an authoritarian state. They haven't done it. There's a deep reluctance amongst the elderly population about getting these vaccines, and breaking down that reluctance and that concern is something they've struggled to do. The other question is, why haven't they approved mRNA vaccines? I remember speaking to the head of the conglomerate Fosun in 2020 in China. He said, we are going to be getting the rights to the mRNA vaccine. That never happened. That appears to be a nationalistic decision by the leadership in Beijing. They wanted to be able to generate and develop their own mRNA vaccine. They've yet to do that.
It's folly to try to predict what Xi Jinping is going to do. People are trying to do just that because it makes such a big difference in terms of outlooks for next year, with some people, including Goldman Sachs, saying that this increases the chance of a messy exit to COVID-0. What does that look like? Do you think that this increases the chance of a forced and messy exit from this policy?
A messy exit may be the implementation of these restrictions at a slightly softer level. They put in place this 20-point plan that they published a couple of weeks ago. The challenge for local officials on the ground is trying to implement those, having spent the last 3 years fearing being punished for not curbing the rate of infections. So the two things colliding together, and if you're a local official in that jurisdiction with that 20-point plan, it's very hard to implement, given you just spent the last couple of years with that fear in terms of what the central authorities are looking at. So this could be a mixed approach of easing some of these restrictions, trying to ramp up the healthcare facilities to ensure that they can absorb the increase in infections and possibly, sadly, the death rate as well. That would be the messy outlook. The history of Xi Jinping is that he has stated that he has studied the Soviet Union's collapse, and he said it collapsed because they were not strong enough, they were not brave enough to confront the challenges within their domestic population. This is a man who studied the fallout of the Soviet Union. He does not want to see the same thing happen. That suggests he will be taking a hard line on these protests.
Okay, but what does that mean, right? Does that mean throwing everybody in jail? Does that mean that they're just going to be a complete clampdown in a new way? Or does it mean that COVID-0 gets even more intense? Is that kind of what people are expecting?
It may be a combination of all those things. You may see the security services starting to target now who they would consider the ringleaders in these protest movements across these various different cities. Certainly the clampdown shared online. That's been surprising in itself that they haven't been able to maintain and contain that yet. Those things, I'm pretty convinced, will be coming, sadly, for the protesters involved. And then, at a later stage, they may start to ease some of these COVID restrictions. They won't want to do it now. They won't want to apologize, because that will be a loss of face for the leadership. But in the months ahead, it would be unsurprising. It would be surprising to see that they don't walk back some of these restrictions and try and walk this fine balance, this fine line to the end of COVID-0. Whether that's before Q2, as Goldman Sachs says now, they're 30% chance, or in the second half of 2023. The imperative is clearly there.
Tom McKenzie of Bloomberg, thank you so much. We really appreciate your insights. It's been a tremendous moment as we watch some of those images of people holding up blank sheets of paper to indicate the censoring that they are experiencing on social media and beyond, and saying we want to be heard. A very unusual type of development in a nation known for cracking down on protests, leaving a lot of people drawing comparisons to the Tiananmen crisis back in 1989. In markets, it is a knee-jerk risk-off field, but that is interesting to me, the fact that you're seeing a stock sell-off and you're also seeing bonds gain, yields lower, this inverse correlation, the 60-40 kind of reasserting itself, the S&P lower by 0.7%. Dollar weakness, that is the one outlier with all of this. Why is the dollar the weakest versus peers? If you look at the DXY index going back to August, we're seeing euro dollar go to 104.62, 10-year yields lower, 3.68%, or excuse me, they've actually shifted higher. Sort of interesting. They started the day lower. They have now shifted slightly higher, about flat. And what we've seen in oil prices is lower as we talk about the potential for more disruption. Coming up in Balance of Power on Bloomberg TV and Radio, Anna Ashton, China Corporate Affairs and U.S.-China Director at the Eurasia Group. From New York, this is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Kicking off the trading week with a little bit of risk aversion. Live from New York City this morning. Good morning, good morning. Equity futures down about 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, entering the final stretch of 2022.
There's going to be a lot of data.
We're obviously waiting for Powell on Wednesday.
This month's employment report.
CPI day.
The Fed meeting.
We've got this twin terror events.
I think it's going to come down to inflation and how the Fed reacts to all of these numbers.
On December 13th and 14th. I can't remember a time when the CPI and FOMC were on top of each other like this.
There's not likely to be a data point that's going to deviate one way or another.
50 basis points is very well telegraphed and priced in.
I do think we're in for a period of choppiness.
The volatility is going to continue.
This recovery isn't going to be easy until we see some progress.
There's going to be ebbs and flows in financial conditions.
We're all subject to the data.
Let's get the show started. Joining us now is John Hancock's Matt Miskin and Greg Staples of DWS. Matt, first to you. What a rally off the lows we've seen of about 20% on the Euro Stoxx 50, more than 10% on the S&P 500. Are you pushing back against that?
It's a lot of it driven from the China reopening narrative that hasn't materialized. In fact, it's gone the complete opposite direction. You look at oil prices, they've all obviously rolled over here. We're lower than where we started the year. Copper's rolled over, Chinese equities are rolled over, yet European stocks, they seem untouched. They seem almost invincible right now. And the euro is even rallying today in a risk-off environment. Used to be the dollar was the risk-off currency. So you're seeing, I think, as we go into the holidays, European equities are kind of the top, or the present du jour, if you will, the hot ticket item. But we're looking to fade some of this risk rally. We think the reopening news is actually reversing here as COVID is becoming more of an issue in China. Growth is slowing, and central banks are still raising rates into slowing economic environment, which we think is going to be felt further into 2023.
Matt, underpinning any view for 2023, you've got to have a working assumption on what you think happens with China. It's amazing to me that we seem to have more confidence around the Federal Reserve and the trajectory of the US economy than we do what's going to happen with China. And it just seems to me that people are willing to push it to one side and say, don't know, but I'll still make a call for 23. Can you make a call for 2023, Matt, without having a decent idea of what China's going to do here?
Well, you have to basically premise it on, are they going to stimulate even more? Because really, COVID, in terms of the U.S. and globally, we snap back so quickly out of it because we did so much stimulus. And if you look at China right now, how are they going to do that? They're going to have to devalue their currency significantly if they're going to issue more debt, if they're going to do more stimulus, cut interest rates as the rest of the world tightens. And if you're going to devalue the currency, you can see capital outflows, which is then going to result in still weaker growth out of China. So we wouldn't pin that down as a strong point regardless. In the global economy, we think reopening will ebb and flow. But nonetheless, the underlying trajectory of the economy structurally is going to be driven from central banks raising rates, which we haven't even stopped yet.
Greg, how are you processing the events over the weekend in China?
I think it's a little bit early to tell, obviously. There might be a binary outcome between a strong repression like we had in Tiananmen Square so many decades ago, or perhaps just letting some of the attention erode from the marketplace at all. I think that they're still trying to figure that one out overall. As far as the internal U.S. data is concerned, I think it's going to be very important to hear what Powell says on Wednesday. What we're seeing now, I think, is a reprise of that risk rally and rates rally we saw in July and August when the market sensed a false pivot and rallied very hard. It got in the way of the Fed's project as they were trying to restrict monetary conditions, set it back a couple of months. I think we'll see the same thing happening now. We've seen a 40 basis point rally in IG spreads, a 100 basis point rally in high yield spreads, and I think Powell is probably going to push back against that on a speech on Wednesday. Let people know that they're really hawkish and they're going to stick through this until they really get inflation under control.
Great. Any reason, though, to believe that it is different this time, comparing the dynamics, the backdrop of now between what happened back in the summer?
We are seeing some early indications that the market is slowing. Obviously, a lot of headlines in terms of layoffs, even though most of that has been in the tech space. And it's not what I would call the demand for tech labor that's been pushing inflation pressures higher. It's more at the lower end of the economic spectrum, your healthcare workers, your restaurant workers, your retail workers, and it's still very, very strong there. But overall, you are starting to see early indications, and we might get confirmation of that later in the week when you, again, look at initial jobless claims on Thursday, and of course, the very, very important non-farm payrolls number on Friday could signal some slowing that's taking place there.
A big week ahead, a big month ahead as well. On December 2nd, we get payrolls this Friday. Then beyond that, it's CPI on December 13th. And Katie Lyons, December 14th, the Federal Reserve, then I guess it's kind of year over, isn't it, Kaylee?
Yeah, I guess maybe not officially, but for this market, it might as well be. 5 actual trading weeks left in this year, and this week in particular is going to be a big one. As you were just discussing, we hear from the chairman of the Federal Reserve, Jerome Powell, on Wednesday, where importantly, we also are going to get JOLTS data. So how many job openings are there still in this U.S. economy? And of course, that will be ahead of other data we get throughout the week, including PCE deflator, initial jobless claims, and then ultimately that payrolls report on Friday, which we're expecting is going to show about 200,000 jobs added in terms of non-farm payrolls. So will we see the softening in the labor market that the Fed is trying to engineer? And of course, all of that ahead of a big second week of December. And what we expect at that December meeting from the Federal Reserve is a hike of 50 basis points. That is what the market is pricing in. Then another hike of at least 25 in February, potentially another in March. The ultimate terminal rate that the market is betting on at the moment is 5.25%. What's interesting is while that terminal rate expectation has moved higher, equities also have rallied. As you all were just discussing, a lot of faith has been put into the idea that that is it. The Fed isn't going to have to go any farther than that as inflation is cooling. But how much upside risk to that terminal rate is there really? It'll be interesting to hear the chairman's comments around that on Wednesday. Does he beat the drum as other federal officials have time and again, reiterating that the inflation fight isn't over, that they're going to keep going until the fight is won, and they see a trend of inflation moving lower back toward their target? And on the subject of inflation, of course, that CPI data coming up on the 13th, we know those prints have the potential to move the market in a material way in either direction. When it has come in hot above expectations, we have seen serious declines in equities, but last month, or this month rather, the print from the month prior on November 10th, we saw a 3% rally in the 30 minutes after that data came in cooler than expected. So my question, John, is can you get a downside surprise, the right kind of downside surprise, 2 months in a row? And does that make a trend for this Federal Reserve?
Katie Lyons, thank you. Setting up the Federal Reserve and the data still to come. Matt Miskin, let's go to the Fed. If you go to the projection materials from the September meeting, open that up, go through the SEP and look at the shift on rates for 2023. They went from 380 to 460. Big jump, Matt. The chairman's teed up another move, potentially of the same size. How much scope do you think is there for pushing that rate much higher from here?
Not much at all, frankly. We think that basically the bond market's right and that we see another 50 basis point rate hike in December. You know, you look through the Fed minutes and the word slow came up 24 times, slow or slowing. Whether it was the jobs data, the inflation data, and that was before the CPI report. So, you know, we think they are going to slow down. They're going to slow their roll with a 50 basis point rate hike in December. We think 25 in the early 2023, but actually they might be overly hawkish in terms of how it's being priced in. But we forget about the balance sheet sometimes. You know, we do all this work on what are they going to do for rates. The balance sheet is now running at $95 billion a month coming off. November was the first month of that. And we did 75 basis points and 95 billion off the balance sheet. That is one of the most tightening we've seen in decades of this cycle. And that is going to be felt well into next year. So the Fed's already done a lot of the work they've needed to do. We think inflation comes down, growth comes down with it. But fixed income looks really good here as we go into 2023.
Matt, given what's happening with the balance sheet, how much signal can I take from the yield curve? A number of years ago, if I said 2s, 10s was flattening, we're about to get inversion, I'd get pushback. I'd say, yeah, but the balance sheet this, the balance sheet that. 2s, 10s right now is negative 80 basis points. How much signal is there?
We think there's a lot of signal, and we think it's the most underappreciated. So now all of a sudden we've been following this forever. Now we're throwing it out because markets have held in okay. But if anything, the 10-year should be higher, all things considered, because the Fed is unwinding its balance sheet. So market forces are pushing down that 10-year even more, given that the Fed is unraveling at $95 billion a month. So if anything, you should look at it more, given the long end is compressing so much and the short end is so elevated.
What's the signal, Greg, from 2s, 10s at negative 78 basis points this morning?
I think right now we respect that signal. It means that the market is perceiving that the Fed is going to have to over-tighten and really send this economy into recession. Long term, though, we think an inverted yield curve is really not an equilibrium. An upwardly sloped yield curve is the more normal, if nothing else, because you want to get a term premium into the yield curve overall. And moreover, if you're buying the 10-year right now at a 360, 370 yield, you're looking at financing that at 4.25, negative 60 basis points of carry. For fast money, if you believe the Fed's going to be on hold through 2023, that's going to be extremely painful. So we do see a re-steepening of the yield curve in 2023. It's a little bit early there, but I think that's one of the big trades, and if you get into it, you're going to make a lot of money.
To be clear, though, Greg, that steepening led by a 10-year yield climbing and not a 2-year yield falling?
Exactly. I think that the 2-year yield, as we get deeper into 2023, is going to start to anticipate Fed easing in 2024. Think of mid-year or third quarter as the Fed starts to signal the true pivot. And then on the long end, you're still seeing inflation running at 3 to 4%, as well as some of the impacts to QT, leading to a 10-year Treasury north of 4% for much of 23.
Matt, final word on that.
Yeah, we think the Fed is going to be cutting at the back half of next year. Recession's only starting. We think it actually begins at the start of the year. You're seeing these layoffs. You're seeing the jobs market weaken. Jobs report Friday is going to be huge. But if that weakens, the Fed's going to be cutting sooner than we think.
It's a crazy time, isn't it? Greg, you said it in your notes. We're discounting a recession and pricing in a recovery before we've even had the recession.
Yeah, it's a strange time. The markets tend to do that. And again, that's why we've had the pivot rally in the summer. Powell pushed back very hard in Jackson Hole, and in his press conference after the November meeting, we're rallying again. That's why we expect him to push back, not quite as hard, but to say, hey, you might be getting a little bit too enthusiastic here in the rates market, in the credit market, even in the equity market.
Straight from the script of the last Fed meeting, maybe. Equity futures down about 0.8% this morning. Matt Miskin, Greg Staples sticking with us. Coming up on this program, unrest growing in China.
We're entering 2023 when there's just so many unanswerable questions. In China, which has been a pillar of global growth for the last 20 years, we just don't know where this is going.
That conversation up next.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
As long as
we're seeing the ongoing COVID zero policy, we're not going to see, much of a stabilization in domestic demand.
At this point, it looks like that a rapid opening of the economy will be worse for China's growth.
The outperformance that we have seen in the Greater China region could be capped in the very near term.
The next few months are clearly going to be challenging.
The biggest problem now, of course, is in the labor market.
The domestic challenges are huge.
They are massive. Protests spreading across China, citizens pushing back against the nation's COVID-0 policy, some calling on President Xi Jinping to step down. Goldman expecting the headwinds to continue, writing the following: the central government may soon need to choose between more lockdowns and more COVID outbreaks. The current situation imposes further downside risk to our below consensus Q4 forecast. Our 30% subjective probability of reopening before QT next year includes some chance of a forced and disorderly exit. Joining us now, team coverage here at Bloomberg, Alan Wan in Shanghai and Damien Sassa here in New York. Alan, can we start with you just describing how different the events of the weekend are compared to what we may have seen in previous demonstrations over the last couple of years?
Oh, sure. I mean, I've actually witnessed a few demonstrations in the past, back in 2011 at the Jasmine Revolution. And even last year, I went to Shenzhen to cover the Evergrande protests. But those protests were very targeted, very limited. And the protest over the weekend was huge. We had several thousand people marching on Wulumuchi Road, which is a very fashionable area of the French Concession. Several thousand people, a couple thousand people, young and old. They were calling for everything from the end of COVID-0 to the release of prisoners who had been detained a couple days earlier because after a peaceful vigil, and even calling for political change. And they were they'd be confronted by police. I mean, we were talking about hundreds of police who were busted to confront these protesters. And what I gotta say was really tense and chaotic. Not particularly violent, but there were episodes of violence. Basically, I saw police haul away a couple of protesters. One of my friends is a cameraman for BBC. He was detained and he was allegedly assaulted as well. So this is definitely not something that I've experienced in my 13 years in Shanghai.
Alan, can you help us also understand the potential for a policy shift off the back of these events over the weekend? It's a big conversation in markets whether we will get that shift away from COVID-0 because of something like this. What's your reading of that situation?
Right. I think there are basically the government has two options, right? First, it could relax. Well, a lot of people have been expecting, this is the reason why we've had a rally in the markets over the last few weeks, expectations that we're going to have an early exit from COVID-0, possibly after the National People's Congress in March, and that has fueled a rally. But given the recent upsurge in cases, that's going to make it quite difficult. But given the fact that we've had some, massive protests over the last few days, not only in Shanghai, but Beijing and Wuhan, spread nationwide, this could put pressure on the government to sort of accelerate, an exit from COVID-0. That said, the government hasn't really said much about it so far, but the Communist newspaper, the People's Daily, said that they plan to stick to COVID-0. So there's a chance that the government will just double down on COVID-0. And that's even more concerning given the fact that early this month, the government unveiled these guidelines to loosen the rules. And now there's been sort of a reversion, from all of that. So there are these two options, and we're not quite sure which one is going to win out. So we're just going to have to wait and see.
Given the vaccine coverage and vaccine efficacy in China, it's a choice between more lockdowns or more COVID outbreaks, Damien. That's what Goldman is indicating. Goldman also raising this, Damien, and I thought this line was interesting. The chance of a forced and disorderly exit from COVID-0. Damien, what do you think that looks like?
Well, look, for me, I have to agree with a lot of things Alan, Tom, and a lot of our people on the ground in China are seeing and saying. But for me, President Xi does not respond well to a forced response. And I just don't see that happening again this time. I think you have to look to Hong Kong in 2019 for a comparable as to what we're witnessing today. What's interesting about Goldman Sachs is they're saying, yes, there's only a 30% probability they're going to exit early being in the first quarter, but there's a 60% probability they're going to exit in the second quarter. I think you have to even push that back. Look, this is not going to, we all knew knew it was going to take time for COVID zero to unwind. Now it's going to be, in my opinion, that much longer. I just don't see Beijing responding that well to any forced measures.
So base case for growth next year, Damien, for you and the team, looking at China at the moment?
Four handle.
Four handle for the year?
Yeah. I think that's really where the market is. I mean, we're looking at 3.9% in the fourth quarter of this year. I think people expect it to rebound mostly in the second half. It's going to be a tale of two halves in 2023, Jonathan, as was 2022, with, I think, rosier times ahead as we push into, push into the autumn months. But I think where we are right now, 720 on dollar yuan. I mean, all the way back, it was at 705 just a few weeks ago. We were down 1.6% overnight. In China, the Hang Seng China Financial Enterprises Index, it was off as much as 4.5%. What's the most interesting thing, 286 on the China 10-year. You got to watch that yield. It's at the highest all year, okay? And 290 is resistance. If we go through that, I mean, foreign investors, only 9.4% of foreigners own CGBs or were holders of CGBs as of the end of August, Jonathan. That's the lowest in 25 months.
Damien, great coverage as always. And to you, Alan, thank you for being with us as well late into your evening. We appreciate it. Apple this morning, a stock to watch. The stock is down by more than 2%. Our latest reporting here at Bloomberg suggesting that the turmoil at Apple's key manufacturing hub in China likely to result in a production shortfall of close to 6 million iPhone Pro units this year. That's a lot. One thing we've also heard from the likes of Jefferies is an estimate around Apple's revenue forecast. They said a number of weeks ago that they estimate the impact to be about $1 billion of revenue and about 1 cent in EPS per week of lockdown. Now, Matt Miskin, these numbers are big. And I think for me, the question now, Matt, is whether the bigger concern for you off the back of events in China is a demand side story or a supply side one. Which one is it?
I think it's more demand side. China has been such a huge incremental growth engine. And if they're if they're not reopening, then that's going to change the global economic output and total ecosystem is impacted. Supply side is going to be an issue and earnings are going to come down. I mean, and the fact is we're trading at 17, 18 times earnings on a price to earnings ratio basis, and earnings estimates are only 4% off all-time highs. We see that coming down more into 2023. But, as we get through Thanksgiving in the United States, the thing, in terms of markets that we're most grateful for is there is an alternative to stocks now because bond yields are so elevated. So there's income to be generated as we go into 2023. We would push more into the fixed income side of markets, look for high quality income because there's risk to the earnings downside, whether it's Apple or some of the other big companies out there that have this global supply chains and global demand that they need is going to probably be weaker into 2023.
Matt, outside of the front end of the yield curve in the Treasury market, where is that opportunity in fixed income?
Yeah, I mean, we're right in the intermediate. We're looking to go longer as we get further into 2023. But right now, investment-grade corporate bonds are trading about 90 cents on the dollar. They were down to 85 cents. That's the lowest since 2008. We're looking for 2008 type discounts in bonds. High yield is not there, but higher quality bonds have seen those kind of drawdowns that they saw in 08 type levels in the corporate market, at least. We think that's a good opportunity into 2023.
Greg, do you agree? Final word.
I'd just be a little bit more in the inner on the yield curve. We think 2s and 5s are quite attractive. You're seeing yields that are available north of 5%. I'd be a little bit cautious as you go further out, only because of the fact that, again, IG spreads have rallied so much, 10-year rates have rallied so much, 75 basis points within the past month. I think it's well ahead of itself, not a good entry point.
Greg Staples, Matt Miskin, to the two of you, thank you. Appreciate catching up. Thank you very much. Equity futures right now down 0.9% on the S&P 500. A whole lot softer this morning. In the bond market, your 10-year, the yield unchanged on a 10-year in the Treasury market, 368 at the front end. Yields just a little bit higher on a 2-year, 446, call it 447. And 2s, 10s pushing negative 80 basis points, negative about 77, negative 78 at the moment. Coming up, the morning calls, and later, Chairman Powell delivering his final remarks ahead of the December rate decision. That conversation just around the corner.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Minutes away from the opening bow this morning. Good morning to you all. Your Monday morning price action looks like this: down about 0.9% on the S&P. On the Nasdaq, down about 0.75%. That's the price action. Let's get you some morning calls. First up, JP Morgan upgrading Wynn Resorts to overweight, expecting China's economic reopening, if it happens, to fuel a rally in casino stocks next year. That stock is positive by more than 5%. Up next, Barclays downgrading Tyson Foods to underweight, saying protein companies face a difficult outlook as consumers spend less and prices keep rising. That stock is down by more than 2%. And finally, Morgan Stanley downgrading Williams-Sonoma to underweight, expecting negative earnings revisions amid weakening demand. That stock is negative by, let's call it, 3.9%. Coming up, US shoppers kicking off the holiday season with a muted Black Friday. That conversation up next with Crossmark's Victoria Fernandez. That conversation just around the corner, together with the opening bell, with equity futures down 0.9% from New York. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
it means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Twenty-four seconds away from the opening bow this morning. Good morning to you all. Equity futures negative through most of this morning. We're down by 0.8% on the S&P 500. On the Nasdaq, we're down by 0.7% on the Russell. The small caps down by about 0.75% also. Coming off the back of a week of gains on the S&P 500 and looking to close November with a month of gains over the next couple of days as well. There's the opening bow. Switch on the board and get to the bond market. Yields look like this on a 10-year, unchanged at 368.30. At the front end, 2-year yields just a little bit higher through much of this morning. 2s, 10s very close to negative 80 basis points. The euro 104.38, positive 0.4%. One ECB speaker earlier on today said talk of over tightening right now is a joke. We'll get into a conversation with Mike McKee later as to whether that's a joke or not for the Federal Reserve. The holiday season very much underway. The shopping picking up over the last couple of days. Abigail Doolittle has more on that. Hey, Abby.
Hey, John. Well, early signs are certainly not great about holiday shopping 2022. Before taking a look at some of those more traditional names, let's take a look at two of the indirect holiday names, also why the markets are down so much. Apple and Tesla, and of course, Apple down in part on the China tumult and that exclusive reporting by Bloomberg that there could be a default or a shortage, I should say, of 6 million iPhones. And you were talking about demand versus supply. I would say it's also supply, because I have tried at a number of stores in this area to buy one, and you just simply can't get them, not even the Pro, just the regulars. And Tesla, of course, 25% of its revenue coming from the China area. So folks may be not buying their iPhones and Teslas this holiday season or have a problem buying them. As for some of those more traditional names, the retail sales picture, not great, although we have a little bit of a uptick there for Walmart, not surprisingly, one of the staple stocks that is higher on the year. But Black Friday sales, according to Retail Dive, rose by 2.3%. Online sales by just about the most. BI channel checks, John, indicating that the U.S. Northeast had better crowds than other areas. But both Macy's and Kohl's talking about the fact that opening traffic for their stores down by about 3/4 to later in the day. So again, channel checks, muted action for this holiday season so far.
Is Cyber Monday actually a thing, Gabby?
For me, not so much. I am definitely a bricks and mortar person, so I can't speak to it, but it looks like that growth this year, John, just about 2.9%. When you account for inflation, not very much at all.
Abby, thank you. Abby with the stats this morning. About 2 minutes into the session, equities down by 0.6%. Staples outperforming, unchanged. Energy underperforming. Crude getting hammered. Crude's come down from the low 90s to the low 70s in just a couple of weeks. Just a monster move through November. Huge range of about $20 or so. Energy this morning. Energy equities down by almost 3%, negative by 2.95%. Cyber Monday then, testing the U.S. consumers' resilience.
Consumers have delivered this year.
This is an interesting year.
Consumer sentiment is at a record low. We have had a very steady pace in terms of overall spending, and the labor market is great.
There's still a lot of pent-up savings. There's still a lot of liquidity in bank accounts.
People, when they have income, they spend it. Americans have income.
Most retailers expect it to be a sort of subdued holiday season, not a disaster, but a more promotional holiday season.
And honestly, I'm not too worried about some of these businesses, the big businesses, taking a little bit less in profit.
Investors keeping a close eye on profit margins amid mounting economic concerns. Crossmark's Victoria Fernandez writing the following: inversion of 3-month and 10-year yields leads us to believe we are more likely to have a recession in 2023, but it should be mild as both household and corporate balance sheets remain decent. Victoria, I'm pleased to say, joins us right now. It's a question we've asked for a number of months, Victoria, and it's great to catch up with you again. Just how resilient is the U.S. consumer?
Yeah, I mean, look, you and I have talked about this numerous times this year, and I am of the strong belief that the consumer is stronger than a lot of people think it is. There is a dichotomy, right, between a higher-end consumer and a more average consumer. We are seeing that. Some of the more luxury items, luxury goods, sales are a little bit better. We have seen the higher-end consumer actually come down a little bit from their usual spending, shopping at places like Walmart, but the spending is still there. This is going to be the foundation, I think, that we have leading into next year, that I think we will have a recession. The 3-month to 10-year tells you that, because now we're inverted, I think, a little over 60 basis points there. But the balance sheet of both the consumer and corporations at this point in time is going to hold us to not have a very steep recession.
Victoria, when it comes to headlines on spending that we've all seen over the weekend and through this morning as well, what's more instructive to you, value or volume?
Well, I think it's going to be a combination. And look, I know the numbers were not as strong on Black Friday as a lot of people thought they would be. Some of that, I mean, for my household, we stayed home until late because we were watching the World Cup game, U.S. versus England. We didn't even hit the mall until around 4 or 5 o'clock in the evening. So perhaps there were some things going on that people didn't go out quite as often. I think today will be an interesting time, Cyber Monday. Let's see what kind of sales are there. Let's see what kind of promotions we're getting. But there weren't a tremendous amount of those doorbuster deals that a lot of people were waiting on. So your ticket items are going to be a higher price, which means the sales themselves will be higher. I'm not sure volume will be as much, and that's going to come down to those companies then that have the pricing margins and the pricing power. They're the ones that will do well this season.
Victoria, are you seeing signs of borrowing picking up to maintain some of this spending?
Well, we obviously see credit card usage going higher. It's getting closer to what we consider those pre-pandemic levels of where they are. The balance of the debt on their credit cards versus their total debt limit is moving higher. But again, higher than where we were the last 2 years. So many people had paid down their debts with some of their stimulus payments that the consumers were in such good shape, they had room to build up some of this revolving credit. So we are seeing that. I think it's something we have to continue to watch. We're not extremely worried about it at this point in time, but let's see what happens over the holiday season.
And Mike McKee, this will be on the Fed's radar, that's for sure. We hear from Chairman Powell on Wednesday.
Yeah, this is a very busy week, John, for everybody. A lot of data, and it is one of those rare weeks where the big number of the week jobs is going to be overshadowed by the Fed, by Jay Powell on Wednesday. You take a look at what's going on Wednesday, not just Powell, but JOLTS. So he'll be talking about the labor market. And the question we're going to have is, which Jay Powell do the markets get? Do they get the one who came out on November 2nd at the end of the last Fed meeting and was very hawkish? At least that's how his remarks were interpreted. Interest rates going higher than expected, a ways to go, too premature to think about pausing. Or do we get kind of the Fed speak that we got out of the minutes last week? An increase would be a danger here. A slowing in the pace of increase may be appropriate. Policy tightening could raise risks. We're going to have to wait and see what we get from him, but probably he's going to lay the predicate for a 50 basis point move. Now, he is talking about employment, and it is employment week, so it's going to be interesting to see what he has to say about this. And I want you all to pay attention to this. Take a look at when the Fed is raising rates, which is the white line, and unemployment. Usually, unemployment does not start to really go up until the Fed has almost finished raising rates. And we have not seen unemployment go up. It's a lagging indicator. So we'll see what we get on Friday. We're at 3.7% right now. But do we start to see the same kind of reaction we've had in the past, or is this truly a different time, John?
Mike, I wonder if you're on the same page of Andrew Honenhorst over at Citi. This is what he had to say this morning. Base case would be that Powell would guide a well-expected slowdown to a 50 basis point hike. But, he went on to say, remaining hawkish by downplaying 1 month of softer inflation data, the jobs numbers may serve to emphasize his hawkish focus on a tight labor market. Mike, what do you make of that last line?
Well, I think that's extremely possible. It's a little early to look at the consensus forecast of economists for jobs because we get all that data this week, but it's about 200,000 right now, which is roughly where we've been. And as I mentioned, unemployment hasn't gone up. So the labor market is stronger than people have thought it would be. Now, maybe it's just delayed, or maybe this is a different time, but it could reinforce some kind of hawkish message.
Mike McKee, thank you, sir. As always, Victoria Fernandez back with us. Victoria, is it a different time in this labor market, or is that weakness just slightly delayed?
Well, I do think it's going to be a little bit delayed, but I think Powell is going to come out this week. And look, I think he agrees with the market, Jonathan, on a couple of things. He's going to agree with the market that the terminal rate is going to be higher than where it was at the September meeting, probably have a 5 handle on it or right at 5%. He's going to agree with the market that the December rate hike should be about 50 basis points. I think where he's going to disagree with the market and really push back is when it comes to the rate cuts that the market is pricing in for next year. And part of that is because the labor market is as strong as it is right now. Obviously, we have to wait for the lag effects of previous hikes to work their way through, and it is a lagging indicator, as Mike mentioned, but I think he's going to use that as a reason to tell the market, look, don't expect these cuts that are priced in. We're going to stay higher for longer, and that's going to be his pushback against the market.
Victoria, are we witnessing, though, maybe experiencing a period of time where the effectiveness, the power of that Fed speak is declining, has been eroded? Markets don't seem to be paying attention in the same way they have done.
Yeah, there's, a lack of confidence, I think, over the last year and a half that has developed in regards to the Federal Reserve. I mean, obviously, it all started with the transitory comments and things moving on from there and showing that that wasn't exactly what happened. So there is this lack of confidence in the Fed, and I think the market is saying, look, we have somewhat driven the Fed with what we're doing. Loosening financial conditions based on what they think the Fed ought to do has driven some actions by the Fed over the last couple of years. I think what Powell is trying to do here is say, we're not going to do that anymore. We are standing firm based on what we think is going to happen. Obviously, it can change with the data, and there's a lot of that coming. But I think the market feels like it has a little bit of power here, and it's trying to use it.
Hey, Victoria, wonderful to catch up, as always. Victoria Fernandez there. I want to check in on the euro just briefly. Euro dollar right now, off session highs, positive 0.4% at 104.33. Something we've talked about in this program a few times over the last couple of weeks. Just a sequencing here in the United States. We have arguably seen a peak of inflation before the economy has rolled over. In Europe, maybe it's the opposite. You can make the argument the economy is rolling over before we've seen peak inflation. ECB President Christine Lagarde just moments ago, I wouldn't go as far as saying inflation has peaked. The following headline, risk to inflation and the outlook are on the upside. Remember, the next ECB decision is on December the 15th, the day after the Federal Reserve's last decision of the year. We'll get back to that story a little bit later, no doubt, on Bloomberg TV and on Bloomberg Radio. Coming up, the US easing oil sanctions against Venezuela.
Is this oil that's already on the market just on the black market? Or is production actually going to increase in Venezuela, in which case that could be meaningful for the market?
The nuances of that conversation up next.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad, and crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
That we're short on detail here in terms of the Chevron story. So, for example, is this oil that's already on the market just on the black market, or is production actually going to increase in Venezuela? In which case, that could be meaningful for the market, but probably is going to take quite a long time to actually get going.
The Biden administration giving Chevron the green light to resume oil production in Venezuela, a move that could add supply to the global oil market and ease price pressures at the pump. This as crude plunges to its lowest level since 2021. Joining us now is Bloomberg's Dan Flatley, joined us from D.C. Dan, can you walk us through the significance of this move from the administration?
Sure. So this is a move that's sort of been teased in various aspects over the last several months, something that we've been expecting, although there hasn't been confirmation, obviously, until over the weekend. But what we know is that this gives Chevron a limited period of time to do maintenance on its projects in Venezuela and potentially move some product to the U.S., though that will be in a very limited capacity. And all this is predicated on what will happen in the talks between Maduro and the opposition party in Mexico City. So if you read the general license from Treasury and you look at some of the comments from lawmakers here in the U.S., this is sort of a very short timeline designed to give the Maduro regime, the Maduro administration, an opportunity to move forward with those talks. But the statement from the Senate Foreign Relations Committee Chairman Bob Menendez coming out shortly after the announcement was made on Saturday sort of lays out the stakes here. So if there is no progress made, this could be potentially reversed in the coming months, and the Office of Foreign Assets Control, which oversees sanctions for the U.S., has shown a willingness to reverse these sorts of decisions in the past. So there's still a lot of developments to come on the political front with this decision.
Well, it sounds like you think there could be scope. There's potential here for this to become something much, much bigger. In the near term, though, just going through the details of our story, in 2020, before the U.S. ordered a complete halt of drilling operations, Chevron's share of Venezuelan crude production was 15,000 barrels a day. Now, for people who are not familiar with the oil market, that's less than the production of a single oil field in the Permian. So, Dan, just how significant is the current decision? How should I be thinking about it?
I would think of this as sort of a near-term decision, something that will, as the previous commentator said, take some time to come online if it indeed moves forward. But I think that there's still a lot of political risk here. If you look back at the history of this decision and whether it was going to be made or not, there was a lot of opposition, especially from Democratic lawmakers and the Florida delegation. And so I mentioned Senator Menendez's statement earlier, and that sort of gives you a sense of where this is likely going. But there's still some significant political risk here in that this decision could be reversed. And whether or not it has any material impact on the price of oil going forward is sort of a matter of, I would say, optimism at this point rather than what we know could or could not happen going forward.
Dan, appreciate the framing. Really do. Fantastic. Dan Flatley there of Bloomberg down in D.C. Crude this morning on WTI down about 2%, down 1.9 to $74.80. Looking ahead, over the last couple of weeks, global credit markets have been rallying along with global equity markets. With the view for the year ahead, I'm pleased to say that joining us now is Oaktree's head of performing credit,
as we enter 2023. We are seeing the impacts of commodity inflation, labor cost inflation, some demand destruction as companies try to pass through cost increases to their customers. So I would expect that there would be some continued volatility around credit spreads. But with that said, there are some bargains to be had. It is a credit picker's market, and we are seeing some very attractive situations in terms of dollar prices that are available in the market and absolute yields that are available in the market for companies that won't experience defaults or losses. So it is an opportunity as well as a risk, and one must tread carefully.
Where are you finding those opportunities? Could you be more specific?
Generally speaking, higher quality, high yield bonds offer attractive opportunities. The percentage of BB rated high yield bonds is the highest it's been in 10 years, with about 60% of the market being lightly levered and offering an attractive return with dollar prices on those instruments in the 70s and 80s. In addition, private credit, certain types of private credit markets are experiencing dislocation given the banks having stepped away from large cap direct lending to leverage buyout sponsors. So there is a widening in the pricing that we're seeing in direct lending, as well as a tightening in the legal protections that are available in direct lending.
It's a buyer's market, that's for sure, and that's a change from what we saw in the last decade. And you mentioned the improving quality of the high yield index, and many people on the same page, we all see the same thing. With that in mind, Armin, can you tell me how you think the index will perform in a downturn relative to how that index has performed in the past?
It's a great question. I think that the index is already predicting some level of a recession. Spreads generally are on the wide end of normal. Typically, high yield bond spreads are between 300 and 500 basis points. Today, we're on the wider end of that range, which suggests that there's an expectation of some level of risk and default as we head into 2023. So long story short is that some of the risk is already priced in, but I would expect that at some point next year, as we lap tough comps or easy comps in 2022, that we will see improved performance in the back half of 2023 and into 24. And so I think the market, in anticipation of that type of improvement, will likely be ahead of the fundamentals. And I think actually by the time 2023 and 2024 are over, they will be very strong years in terms of index performance. But obviously this year it's been a challenging year for high yield.
Can I work through just the following with you? So we've seen the bulk of the tightening cycle. You've indicated we've started to see the consequence of that. People started to price in the downturn. Can you tell me something, Carmen? And this is where I'm really interested. When does the maturity wall start to become a problem? It's certainly not next year. But if the Fed is sticking with this high for longer story, we've had the higher rate story. Let's talk about the longer piece of it. I mean, when does that start to become a problem? Where is that maturity wall on the horizon?
It's really 2027, 2028. If you look at the maturity schedule for high yield bonds, only 6% of that market matures between now and the end of 2024. In the case of broadly syndicated loans, it's a little bit higher. It's about 8.5%, but still quite manageable. But if you were to really dig deep into what subsections or what ratings categories are spread across that maturity profile, it's really the triple C's and lower rated securities that are maturing in the near term. And therefore, there will be some level of defaults, but the percentage of triple C's in the market is quite low right now. It's under 10%. So I don't think that there is going to be a maturity-driven default experience in the next 2 years. The maturity wall is substantially extended at this point, and I don't think that we will see defaults driven by maturities. However, with floating rate borrowers in the broadly syndicated loan space, or even in the private credit space, especially in highly levered transactions with LBO sponsors, we will see some level of defaults and losses associated with those credits, because they were very aggressively capitalized over the last 2 or 3 years, and they have the added cost of higher cost of borrowing with floating rates rising as rapidly as they have in the last 12 to 24 months.
Armin, this was a clinic. We appreciate it, sir, and let's have a longer conversation next time. That was Armin Panossian there on the credit market. Just to get back to the equity market, about 23 minutes in, equity's down 0.5% on the S&P. On the Nasdaq, we're down about 0.25%. Coming up, the market moving events you need to be watching, the trading diary for the rest of this week. From New York, this is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
About 26 minutes into the session, equities declining by 0.5% on the S&P. We're down 0.25% on the Nasdaq 100. That's the price action. Here's the trading diary. Fed speak coming up from Williams and Bullard at noon Eastern. U.S. consumer confidence coming up on Tuesday, followed by U.S. GDP and core PCE on Wednesday. Plus, we'll hear from Chairman Powell, along with Governors Bowman and Cook. A little bit later this week, too, jobless claims coming up on Thursday. And finally, we round out the week on Friday with the U.S. payrolls report. In our survey so far, moving target, the median estimate 200K from a previous read of 261. From New York, this was the countdown to the open. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Pepsi's Number Fever campaign in the Philippines
has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. he emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years.